And the lack of volatility, rather than make people feel more confident in coming into the market, is actually keeping large investors on the sidelines, because market makers and other liquidity providers, such as high-frequency traders, they need volatility for it to be worth their while. Obviously, there is some activity going on there, but not nearly as much as there used to be. And with low liquidity, because of the low volatility, then there's greater risk for large investors, both on slippage and exit liquidity, with greater risk, especially given so much uncertainty on the macro environment. They're still hesitant to step in. Liquidity needs liquidity. What will it take to change that? Well, there are some signs of liquidity, some signs of volatility coming back in. It's very much a case of, you go first. No, you go first. No, I insist, after you. But, eventually some brave investor is going to go first, and then others are going to see the uptick in activity, which maybe we've seen, maybe not. They're going to see the uptick in activity, and maybe they'll step in as well. And then liquidity, one day, someday, eventually, it will be back, and then things will move fast. The uptick that we've seen with this last leg down, maybe it's too soon to say we're back, but it could be the start of something. The tailwinds are not inconsiderable.
I want to get your take on use cases, and we're going to talk about that with our next guest surrounding Ether. But in terms of Bitcoin, you often hear it's digital gold, in which case volatility would be more of a bug than a feature, wouldn't it?
Depends on your time frame. Longer-term holders, when you're talking about digital gold, the traders, sure, volatility gives them trading profits, right? But for longer-term holders, they don't really care. It's the longer-term perspective. And while we can debunk the fact that Bitcoin has been an inflation hedge in the U.S., cast your eyes outside. That's all we really need to do. Look at Argentina, 114% inflation. Bitcoin in Argentinian peso terms has tripled year to date. Turkey, they're expecting their already mid-level double-digit inflation to increase further. Bitcoin in Turkish lira terms up over 120% year to date. So again, investors in areas outside of the United States, outside of Europe, do see Bitcoin as a hedge. That's the use case that I think is being very undercovered, underappreciated at the moment.
Noelle, what do you think about the correlation to stocks, or the lack thereof right now? For a long time, every uptick in the NASDAQ 100 was coupled with an uptick in Bitcoin and vice versa. And we've now seen that correlation break down. What does it mean?
Correlation is a wonderful narrative device, Matt. I personally very much enjoy talking about it, but we have to remember it's just a narrative device. What's more, it's a backward-looking narrative device. The fact that Bitcoin has been very uncorrelated to stocks recently, lowest correlation in a very long time, is because of its lack of activity recently, while stocks have been pretty active. That's the only reason. Will this continue going forward? I don't think it will. I think we're going to see correlations start to take up, and they can move fast. They look slower on the charts because correlation is always smoothed over whatever time frame we happen to be applying to the calculations. But you know that when there's a crisis, when there's panic, when there's blood in the water, correlations head to 1. And I believe we have a stock market correction coming. We'll see some correlations tick up there. Longer term, the correlations are breaking down because of the use cases that we just touched on, Matt, because of others that will be emerging. However, it's not really something we can use to predict the performance going forward. And I have heard some analysts say this means investors can start to put it in their portfolio again, and my answer to that is not so fast. The correlation hasn't gone away, it's resting.
I want to also ask about the Ether Bitcoin ratio. As I said, we're going to talk with Paul Brody in a moment about his new book and use cases for Ether, and it started to move a little bit in the last couple of sessions. What do you make of Ether versus, the OG crypto token?
I do believe we're starting to see signs of ETH waking up, and frankly, Matt, about time. It's been very asleep for most of the summer for several reasons. One, the regulatory uncertainty. DeFi has been very lackluster, partly because of some exploits, very high-profile exploits, as we can confidence, partly because many tokens that run on Ethereum have been declared securities. That does impact Ethereum activity, which impacts the price of Ether. However, also the macro attention that you mentioned, a bit that has been directed at Bitcoin, but that is starting to change. We're seeing more investors start to finally take a look at ETH because of the likelihood of an ETH futures-based ETF sometime this year because of the potential regulatory clarity that will eventually happen, even in the United States. And ETH stands to gain much more from that than does Bitcoin. And also, Matt, this is a very overlooked feature of ETH. It's reflexive. It's leveraged on itself. When the price goes up, there are more Ethereum transactions because there's more interest in ETH. And with more Ethereum transactions, more transaction fees. On Ethereum, transaction fees paid in ETH, that ETH is burned, which reduces the net supply, which has been pretty low, slightly negative anyway. So lower to tending negative new supply, all things being equal, will increase the price, which will increase more activity, which will increase more transactions, more fees, more burns, and so on. It's reflective, which is why I think that when we start to see ETH move, again, it'll be fast.
All right, Noelle, thanks so much for joining us. Noelle Acheson there talking to us about the crypto world. Coming up, as I've been saying, we're going to talk to EY's head of blockchain, Paul Brody, about crypto ETFs, about the ETH futures that Noelle was mentioning, and of course, about his new book, Ethereum for Business, a plain English guide to the use cases that generate returns from asset management to payments to supply chains.
And Coinbase shares are rising after taking a stake in stablecoin issuer Circle. We'll have more on that coming up.
Plus, to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
About your economy and Greece. And when you look at tourism, it's booming, but it also means some of the islands are overcrowded. Exactly. Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We see one position from the SEC, which is regulation by enforcement. Nowhere has it really been established what assets are considered securities and which are not. And even in the two Ripple rulings we've seen, which were not even a month apart, we have dramatically different interpretations. The only way that we get clarity is not through these piecemeal regulation by enforcement steps we've seen, but through clear regulatory guidance. And that, in my view, at this stage can only come from Congress.
That was Meltem Demirors of CoinShares speaking to Bloomberg a few weeks ago on this show after federal judges for Ripple and Terra cases split on whether those tokens are securities. And now the SEC has asked a federal judge for permission to appeal the Ripple ruling. Bloomberg's Sonali Basak joins us now for more. Sonali.
Yes, it's the latest in the saga between the SEC. Remember that back in July, District Judge Annalisa Torres had ruled that the XRP token of Ripple Labs is not a security when it's sold to the general public, and the ruling was a preliminary motion and not a judgment. So the SEC is now seeking permission for its immediate appeal, saying that the ultimate answer to these questions could affect a number of pending cases involving crypto assets. In the latest twist between the two industries here, you do have a very significant amount of pushback here between the two parties. Now, we do have this appeal from the SEC. We also have the fact here that the early response of the XRP token has been a huge rebound, but those gains have since waned since then, and it's becoming clear that that ruling may not have been the industry clarity that it has been needed to move forward. Now, remember, as you were just talking about, there's a separate case between the SEC and Terraform Labs, where a separate judge, Judge Rakoff, said the Terra USD might be a security when it's sold to retail investors, and that is just one of many suits between the SEC and the different industry giants, including the largest crypto exchange, Coinbase, which is fighting the SEC on its current stance while also working closely with the watchdog on separate matters in the crypto world, including the advancements of ETFs tied to Bitcoin. Now, for its own right, Ripple is fighting the SEC's appeal. The company's executives, in their own legal response with the judge, say the next step should be a trial, which they say should happen expeditiously and is in the interest of the public. Yet they say that the SEC's appeal should be denied.
All right, Sonali, thanks very much. Sonali Basak bringing us the details of that case that's ongoing. Let's bring in Paul Brody, EY's global blockchain leader, to talk to him about Ripple as well as Ethereum and all things crypto. Paul, I want to first get your take on the SEC case, maybe not as a judge, but just as someone who watches crypto. How important was it that Ripple won at least part of that case?
So I think it was actually pretty important because any step forward towards clarity is a positive step. And I think if you look at the draft legislation that's coming from Congress, it's very, very reasonable. And so all of these things, I hope, are converging towards pressure towards we should have more clarity of rules. And I think what Meltem said in your introduction was fantastic. She's right on target. Clarity is good for business. And hopefully between the legal decisions and the pending legislation, we're getting there in one small step at a time.
Okay, so as we talk about the pending decisions around what is and is not a security, also all waiting with bated breath each and every day to see if a spot ETF approval actually may come, or Grayscale may actually have its ruling come down in the DC Circuit Court. Didn't happen today. We'll see if it happens on Friday, so we'll all wait for that. In regard to ETH futures, though, and that potential ETF, that one seems like it maybe is more likely. What real difference would that make, Paul?
So I think it would make an enormous difference because we're really starting, and your prior guest was amazing on this topic, we're really starting to see the difference between Bitcoin, which is a kind of digital gold, and people want to see it as potentially an inflation hedge or a global asset, versus Ethereum, which is becoming a global computing infrastructure. And so by having ETFs for the two separate ones, and specifically having Ethereum ETFs, you can start to sort of take a stake in the Ethereum ecosystem, in the cash flow of transactions, in the value of the overall asset infrastructure that's being built there. And for people to see these two properly as separate, I think is really important for the development of the overall marketplace.
Okay, so on the subject of Ethereum, you are a somewhat expert on the subject. You actually just wrote a book that was released earlier this summer, Ethereum for Business. It's called A Plain English Guide to the use cases that generate returns from asset management to payments to supply chains. Paul, how should businesses be thinking about using this technology?
So we have a very simple saying at EY, which is that we believe blockchains are going to be the glue that tie business ecosystems together. And even though everyone tends to focus on finance and DeFi and SEC rulings, in fact, Ethereum is an incredible infrastructure for tokenizing assets, tracking supply chains. If we look at the kind of things that I talk about in the book and that we're doing at EY, they are tokenizing carbon offsets, tokenizing carbon traceability, tracking pharmaceuticals, managing procurement agreements, right? There's a tremendous tremendous amount of operational business stuff, none of which is finance related, but is essential for how companies interact with each other. And Ethereum provides a neutral, decentralized infrastructure in which enterprises can transact with each other on level, equal terms.
On the subject of things being level, is this a zero-sum game, Paul? Are we going to head into a world where one chain actually is dominant, Ethereum perhaps?
So I do believe that. I think if you look historically at the world of computing infrastructure, we like standards, right? Basically, you know, a single operating system represents 90% of all PCs. 2 operating systems represent more than 95% of all phones. We like standards. Standards scale really well. So I think we are headed for a global infrastructure where Ethereum is a global base layer standard for digital business transactions in the same way that TCP/IP is a global network standard, and that others over time will gradually wither away. Just like, you know, 20 or 30 years ago, we used to have an alphabet soup of different networking standards, and now we just have TCP/IP.
That reminds me that I love the metric system, Paul, and we're kind of nowhere there in the U.S. Are we going to face a similar disadvantage when it comes to the global blockchain? I mean, is the U.S. regulating itself out of competition here, or not regulating itself into competition?
I worry that there is some risk of that happening. I just actually got back from 4 weeks in Asia, and it's very clear Japan, Hong Kong, Singapore, and additionally Europe and the Middle East, these are all places that are moving really forward. If we look at kind of our volume of work and deals, we're up in every sector and we're up in every geography, but the places that are growing the fastest by far in terms of our blockchain and core crypto work are Europe in preparation for the MiCA assets law, and Hong Kong, which is growing rapidly as China tries to reopen, and then obviously Dubai in the Middle East, where the regulatory environment is maturing very quickly. So the U.S. is growing again, and that part is good, and I've been telling all the people on our team, you know, summer is coming, but we are definitely lagging compared to other regions.
Summer is coming.
Here in D.C., I have to say I'm really eager for summer to be over, but that's just because I've been drowning in humidity for weeks now. Paul Brody, thank you very much for joining us. He is EY's global blockchain leader and author of Ethereum for Business. Now, coming up, we're going to have more on the story that we promised you we would have more of, Coinbase taking a stake in Circle. We'll have the details next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Crypto. I'm Kaylee Lyons in Washington with Matt Miller in New York. Well, Coinbase has taken a stake in stablecoin issuer Circle, citing, quote, growing regulatory clarity for stablecoins in the U.S. This comes as competition among stablecoins is increasing, even as the overall market value of the sector is shrinking. Let's bring in Bloomberg's Olga Karev for more. She is joining us from the West Coast. So, Olga, what do we need to know about the terms of this agreement? I don't think they were fully disclosed, but what do we know?
So what we know is that the two companies were previously part of the Centra consortium. Now they are essentially getting rid of it. And Coinbase is going to take a 50% share of all interest income that is earned off of USDC. And it's a little bit of a change versus the prior agreement. Of course, the details of that aren't known, but many analysts estimate that Coinbase took a 40% share of interest revenue. So it's a little bit of a benefit for Coinbase. Plus, if Circle at some point decides to go public, which it has ambitions to do that, then as an equity owner, Coinbase could benefit as well.
What do we know, Olga, about the competition in the space, specifically between Circle and Tether? And is the overall market really looking weak?
Absolutely, it is, Matt. And essentially, what's happened this year is that USDC's market share has shrunk and Tether's has increased. So if you look at market cap, Tether's has increased, USDC's declined. Part of it was due to the banking crisis earlier this year. In March, Circle had some deposits trapped in Silicon Valley Bank, and it very quickly got the money back, but the concerns have lingered, and so the market cap of USDC is quite a bit down, while Tether has actually increased its market cap.
Olga, just quickly, we only have about a minute left, but it strikes me they cited growing regulatory clarity as being a reason why this move is being made. I understand that House Financial Services did pass a stablecoin bill, but that hasn't actually become law yet. How much real clarity do we still have yet to see?
Absolutely. So the company definitely said that, but I think we are still ways away from real regulatory clarity on the stablecoin issue. So, you know, I'm not sure if maybe some of the motives for this reshuffle were different, but this is at least what the companies are saying publicly.
Olga, great to have you with us. Thanks so much for filling us in on this important story. Olga Karev there talking to us about Coinbase taking a stake in Circle. Coming up next week, we are going to talk to Clara Medeli from Kaiko. She's going to talk to us about the data involved in crypto and how we can look at that to analyze just exactly what's happening. For Kaylee Lyons, I'm Matt Miller. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into ending record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Welcome to Bloomberg Markets. I'm Amber Kanwar.
And I'm Matt Miller. Let's get a quick check on what's going on in markets today. Bit of a seesaw day. We started out the day up, then dropped, then rose. Now we're back down again. Currently off about 0.25% on the S&P 500. 43.88, 43.89 is the level we're looking at right now on the benchmark index. We're being dragged down by financials after S&P downgraded a number of regional banks in a move that follows Moody's. We also have big losses in some of the retailers, and we're going to talk about those, but that's a weight on the index. You can see the U.S. 10-year yield coming down as investors buy those bonds. The yield right now at 431.81. Remember, yesterday we rose up to 434, the highest level that we've seen since 2007, and we're up really across the curve. Today we're giving back some of those gains in yields as prices rise. The Bloomberg U.S. dollar index right now very little change, but holding at the 1240 level. We've seen it over the last few sessions, relatively strong level, because with high yields come more investors in U.S. dollar assets. And then NYMEX crude down 17 cents, even as prices at the pump rise to the second highest level we've seen them in recorded history, seasonally priced. NYMEX crude going at $80.55 a barrel today. Amber, what are you looking at?
Well, you mentioned financials are a pain point on the S&P 500. So is retail. Take a look at Macy's, which is under huge pressure right now. Sales dropping. And what are they doing in the face of that? They're resorting to discounting to clear inventory. Investors never like to see that. They also did not like what Dick's Sporting Goods had to show in its latest quarter. Profit plunging. They have a huge problem with theft. It's one of the reasons they've had to cut forecasts and ultimately will be cutting jobs. On the flip side, we have shares of Hasbro as one of the best performing stocks right now. Bank of America sort of pounding the table on this one. And NVIDIA briefly touching a fresh all-time high this morning. It's retreating right now. A very interesting setup, Matt, into what should be a big set of earnings releases tomorrow.
All right, we are definitely waiting for NVIDIA earnings tomorrow, but we're seeing a lot of option trading already. Bloomberg's Abigail Doolittle has more on that. Abigail?
We are certainly seeing a lot of options trading, Matt, because we've had lots of volatility for big tech up until today to the upside. And last week, of course, on Friday was options expiration. A lot of times that clears the decks for the bulls to come back in. But I was speaking to Steve Sosnick of Interactive Brokers earlier, who's actually joining us for Options Insight later today around 3:15. Please tune in. Great insights there from Steve always. But he was saying he doesn't think it's really that clearing of the deck, that it's more FOMO buying on some of these big tech names, people wanting to buy that dip. That happened on NVIDIA up until today, basically, where we have this 2% decline. One reason could be, Matt, of course, this stock's huge move. The last quarter, there's so much to live up to. They basically raised their guidance by 50%. We are likely to see a big move after Wednesday, on Thursday. In the third quarter of last year, up 18%, up 8%, and then down in a big way on one of the other quarters. Right now, we're looking for a move of up 10%, and that's not the last quarter, though. So this is, I think I'm guessing that was the move that we had the last time when $143 billion was added. So this is chronologically a little bit out of order, but the clear point is a big, big move. Why? Well, take a look at NVIDIA on the year. This is incredible, Matt. Up right now, 212%, really making the move in the S&P 500 up 14%, look like nothing, along with the stocks up 40%. The question is, will their results deliver like they did back in May? Can they do that 2 times in a row where AI truly lives up to the hype?
All right, Abigail Doolittle setting us up for tomorrow's earnings report and really the market reaction that we'll get on Thursday. A major market driver this week has also been, as Amber mentioned, certainly today, the retail sector. Shares of Macy's, she showed us lower as many retailers anticipate a slowdown in consumer spending. Bloomberg Caroline Hyde spoke with the CEO of Macy's earlier.
Yeah, certainly did. Jeff Gannett. We had a conversation on the phone, Matt, a little bit earlier. And this is a person who's trying to steer and read between the tea leaves at the moment of where the consumer is going in the United States. They are concerned around perhaps sort of pulling back in credit spending on their own credit cards. They are also seeing perhaps a tick higher in delinquencies. Now, they're not worried about the overall credit stability or the underlying, well, strength of the consumer that they service with their credit cards, but they are saying, look, we're returning to cycles that we've seen before. The consumer has more headwinds now than they do tailwinds. Just think about the loans that they're going to start paying off in terms of student loans. They are seeing interest rates on the rise. They have seen inflation. So, look, they're starting to see a consumer who's more discerning, one that wants to spend on experiences, still wants to spend on beauty, and that's why we're seeing Bluemercury outperform and sales ticking higher there on a like-for-like basis. But they are pulling back, perhaps, from the way in which we spend on items, on garments, and that's why we saw Macy's like-for-like sales fall. Not as much as Alice had anticipated, but fall nevertheless. And indeed, even Bloomingdale's, the higher-end clientele, starting to pull back too.
And to what extent did e-commerce blunt some of the overall sales declines?
It's interesting, it sort of didn't. Digital sales were down some 10%. However, this is an area of strength that Macy's feels that they own. Remember, they've been toying and bringing to market, there's something called a marketplace. This is a way that they bring on more brands, more types of things you can purchase, say like, you know, games and the way you might be able to buy a console. You can do that through the Macy's marketplace and now a Bloomingdale's marketplace, rather than always going into bricks and mortar. They've actually just hired a new executive to head up digital and focus on how that intertwines with commerce more broadly. But really, Jeff, trying to say that our aspiration in digital are quite high, and they say at the moment they could be healthier than where they are today. They want to grow aggressively, and this is why they're continuing actually to lean into the world of artificial intelligence as well, and really think that that could be a way in which they break out the mold, start to really think about how they directly access a customer who wants different things. That's, of course, where they'll start to intertwine generative AI and more broadly the way in which we're all interlinking with ChatGPT. But they want to make it easier for customers to get through sort of boundless amounts that we could be buying to get the right thing to buy at the right price point. Remember, they've managed to really reduce their inventory some 10%. And actually, Bloomberg Intelligence saying the reason they're able to do that is because they have been leaning into digital. They have been leaning into data, and they're able to understand what Jeff Gannett called his surgical ability to look at how they reduce inventory that's backed up.
All right, Caroline Hyde talking to us about Macy's dealing with inventory. Thank you very much for that. Let's turn to retail at large with Brendan Case. You know, Macy's had a big drop, but Dick's Sporting Goods was even bigger, Brendan. On the other hand, you know, Dick's has already had a huge run up in the stock. I think they're up 250% over the last 40 years, even counting today's drop. But what's the problem? Is there really an inventory issue?
there's a couple things going on, and one of them is that consumers are more and more shying away from purchases of non-essential items. This is a story that started last year, but if anything, it's caught up, catching more speed this year. People just have less money to spend on discretionary goods after they get done paying for groceries, and at the same time, they want to spend more on services, and that leaves you out in the cold if you're in the business of selling appliances, clothing, sporting goods.
I find the share reaction, though, interesting. Investors choosing to be, or they were at least choosing to be a little bit more forgiving of a company like Lowe's, for example, which also posted declines in sales.
If you look at the big message coming out of Lowe's earnings and Home Depot, it's probably a big part of that story is just relative to expectations. Both of those companies cut their annual forecasts in May, and there was a lot of sort of doom and gloom sentiment around home improvement spending. With Home Depot coming out last week, Lowe's today, things aren't great. Sales are down, profits are under pressure, but it's not falling off a cliff, and so certainly better than expected, where, you know, where you can contrast that with somebody like Dick's, which has been such a star during the last few years, coming in and saying that profits were just a lot worse than expected, and a lot of uncertainty there going forward.
What do we know about the consumer, Brendan? For a long time, the San Francisco Fed was kind of in a debate with the Fed in Washington, D.C. about how much excess savings consumers had left. Now we've seen credit card spending start to go way up and delinquencies as well. How is the U.S. consumer holding up?
So the evidence there is pretty mixed. It's still a strong job market. A lot of people are employed. A lot of people are making higher wages. Certainly not a situation where people are pulling back completely. But if you listen to the retailers, there's really a lot of caution, certainly with what Macy's said today about delinquencies on credit card debt getting worse, especially in June and July. Even if you go back to last week and listen to a big kind of mass market retailer, Walmart, the biggest of them all, which has been doing really well the first half of the year in terms of sales gains, but even they are striking a pretty cautious tone going forward. You've got student loan repayments coming up, you've got higher interest rates, a lot of caution with consumers out there.
Well, perhaps one example of how strapped consumers are is the fact that they're just stealing, and that was a big problem at Dick's. You've seen Target bring it up, and I think whether a retailer is talking about it or not, it does seem to be happening. What are you hearing companies say about that, and what they can do about it? Because we're also hearing more and more that, you know, they're limited on what they can actually do about the theft.
Yeah, it really runs the gamut, and that was such a big part of the underperformance today from Dick's. If you look at what other people are doing, you know, Lowe's said that it was the worst environment for shrink in the 35 years that the CEO has been in the retail business, but he also was at pains to detail all of the things that they're doing to mitigate shrink, especially like, you know, technology that means that tools can't work unless they're deactivated by store employees in a certain way. And what Lowe's said is that it's really not any worse this quarter as it was, you know, last year. But then you take some mass market retailers like Target, you look at Dick's, and certainly one thing people have done is put more goods behind plastic. You see that a lot of the pharmacy chains. The problem there, of course, is that makes people a little less willing to buy in stores, maybe a little more willing to buy online, and not necessarily from the brick and mortar retailer. So trying to strike a balance is a big challenge for a lot of these retailers.
All right, Brendan, thanks so much for that perspective. That's Brendan Case joining us. Coming up next, Microsoft pitches a whole new Activision deal to UK regulators. The details next, but before we go, take a look at shares of Zoom after reporting earnings that has analysts worried about the company's growth. Bloomberg Technology had the CFO on in the last hour to discuss. Take a listen.
Which is really important to remember. A lot of these customers buy online. It's a very important part of our business, and the team is consistently innovating around how do we bring more products to them and how do we expand the top of the funnel. We've seen a lot of stabilization in the churn rate there. We're down to pre-pandemic levels, which is really great. It's just going to take a little longer than we expected to stabilize over time, though.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Markets. I'm Amber Canmar with Matt Miller. Time now for Stock of the Hour. Microsoft's $69 billion acquisition of Activision Blizzard got a new chance at winning approval from UK regulators after submitting a substantially different deal to the country's antitrust watchdog. Microsoft would give Ubisoft rights to distribute Activision games, potentially easing concerns over the dominance in the gaming market. Matt?
Yeah, so it's a fascinating deal, first of all, because of the size and the fact that Microsoft is doing it. Second of all, because I love Call of Duty. And it's amazing that Microsoft is willing to give up the streaming rights to Call of Duty to another company, Ubisoft, for 15 years. To me, that means either this is not only about Call of Duty or nobody plays video games by streaming them. Jennifer Rhee of Bloomberg Intelligence has been covering this acquisition from the start for us and joins us now. So first, I guess the question is, does this do it for the UK regulator? Is this going to be enough to put them over the line?
I think it does. Look, the UK regulator had concerns only about this cloud streaming market, not the console market, the PlayStation and Xbox world. And this basically just removes that problem. I mean, Ubisoft will now be the licensor of the Activision games, as you said, for 15 years to consumers in the UK as well as other countries. And that resolves the concerns. And I think at this point, this will get it over the line with the CMA. That's the antitrust authority in the UK.
Jennifer, to Matt's point, though, does it remove substantially the economics?
Well, I mean, I would say it doesn't, because I don't think Microsoft would be willing to make this agreement if it did remove the economics. And I think at least in the near term, you know, the data from the lawsuit in the U.S. showed that most gamers are still downloading games and not streaming games, particularly games like Call of Duty, where they want to move pretty fast and they don't want the lag time that you can sometimes get if you're streaming through the cloud. But, you know, what they are getting are all these content creators at Activision, and they will get these rights back in 15 years. And so I think obviously it was worth it for them, for this deal to go there. And part of that is because they really want to push into mobile gaming, and they think they need the Activision content in order to do that.
Well, 15 years ago, it was all about Halo.
Right.
I mean, Call of Duty has only been the most important video game on Earth for, you know, about that time, there could be something else, right? Maybe Microsoft thinks that they'll be able to create the next big thing with Activision.
Yeah, absolutely. I mean, that's the thing. They're getting the content creators, right, when they get the Activision assets. And they also bought another studio called ZeniMax a few years back. And so they're gaining more and more of these content creators, and I think that is the idea. You know, we'll come up with the next greatest game. You know, eventually there's going to be another Halo, another Call of Duty down the road, and who knows what's going to happen in 15 years.
They already have the next great thing, ChatGPT. That's sort of the real focus for investors. How should investors think about whether this is a needle mover or not?
You know, I think that it is, because I think obviously it's a $69 billion deal, and Microsoft expects is going to get great assets through this deal, and we'll get these rights back in 15 years, and we'll also be making money, right? Because Ubisoft's going to be paying Microsoft a wholesale price, but they'll be paying sort of as the exclusive licensor or licensee of these games. So there will be revenue that comes in from this Ubisoft agreement. You know, I think that this is a good deal for Microsoft going forward, and again, Microsoft wants to push into mobile gaming, and they think they need this Activision asset in order to do that. And so it's going to help them in that area.
All right, Jennifer, thanks so much for that perspective. That's Jennifer Rhee joining us. Coming up, financial stocks are in focus right now after S&P Global Ratings downgraded and lowered its outlook on multiple banks. Stay with us. This is Bloomberg.
When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Markets. I'm Amber Canmore with Matt Miller. Now, bank stocks are underperforming the broader market as S&P Global Ratings downgrades a handful of lenders after a similar move by Moody's. Bloomberg's Shonali Bassett covers Wall Street for us and joins us now. Shonali, there wasn't anything materially new in these downgrades, but it just seems like investors still don't like to hear about it.
Yeah, there are two things happening at the same time. To the point that you're making, we have seen significant downgrades over by Moody's, and the Moody's news was somewhat worse because you saw a number of firms also placed on negative watch, whereas you have S&P now saying there is a lot of stability after these most recent actions. Still, you have the KBW Bank Index down another 2.2% on the day, and if you see the banks that are moving the most, it's Regions Financials and Zions, so not all of the banks that have actually faced potential downgrades. Remember, S&P said Zions in particular remains negative after the review, and that uncertainty would weigh on the heels heels of these sorts of banks. Now, remember also there's another thing happening today as well. If you're kind of concerned about the direction of interest rates and the impact it's having on the banking sector in terms of the available for sale securities, in terms of the held to maturity securities, and in terms of the price it's paying for deposits, a 2-year yield surging above 5% doesn't help that story and the direction of travel there. So when you take a look at the movements in the banking sector today, that could explain some of it.
So these are the banks that got the downgrade: KeyBank, Comerica, Valley, UMB, and Associated Bank. I looked, by the way, at the KRE and saw that it still hasn't recovered from its initial plunge back in March. So if you look at the big drop, this is the regional banks, the Spider S&P Regional Banks ETF. The big drop that you can see here in March, we're still at that level. So things haven't gotten any better, even if they haven't necessarily gotten worse.
Yeah, and if you take a look at the KBW Bank Index overall, it's worth noting that there's only 3 stocks in the green on the year in the index, and those include some that are not even technically banks. Capital One Financial is up 9%, and remember that had been a bigger gain, so even that firm, which has been doing well in trading, has pared some of its gain. JP Morgan is also up more than 9%, but beyond that, even the likes of Morgan Stanley down 2% on the year. So the banking sector is still feeling a lot of the pain, even for the biggest of the big, which is largely benefited. Now, one problem that you watch as these downgrades take steam here is this idea of issuing bonds into the market. We've had a record amount of issuance, or at least the most we've seen in many, many years, $2 trillion globally, most of that in Euro bonds. So the U.S. has lagged Europe a bit, but the reason the money is being raised is to meet TLAC, total loss absorbing capacity, kind of ratios here that these banks need to meet for regulatory standards. Now, when you look at the cost of funding, there's a potential with these downgrades that the cost of funding for these banks, which has already been a problem, continues to be more of a problem on the heels of these downgrades as they look to tap bond markets to make that buffer even larger.
Shonali, I want to pick up on the point that you made that we're not just seeing this in the regional banks. You're seeing big banks getting taken down. I'm taking a look at shares of Citi. It's erased almost all of its gains from the October low. It is trading now back at the lowest level since October 2022. Is it getting painted with kind of the similar brush and similar concerns about, well, where are they going to be with respect to their capital levels?
This is going to be a really interesting quarter because while capital levels has been a really big question for some of the larger banks, Citi, as you say. Another thing I was looking at, for example, was where Citi has been trading since Jane Fraser took over. And it has been down about 40% or more since that time. Remember, in that time, we faced the COVID pandemic. They're the most global of U.S. banks. If you're worried about their exposure across the world, that's one thing. But then there's also the question of strategy. Many of these banks, Amber, are also facing massive strategic questions in the middle of any potential worries about the direction of travel moving forward. Think Goldman Sachs, down 7% on the year. It is kind of the second worst performer here behind Citigroup. Wells Fargo is up on the year after massive sell-offs in prior years. But Goldman also, like Citigroup, facing massive transformational questions in the middle of a tough economic environment where there's both firms, by the way, are still seeing pressure on trading. There's another story on the terminal right now about how currency trading has just fallen off a cliff this year after booming the last couple of years. So without those fees, you better hope for more Microsoft Activisions around the corner.
M&A needs to come back, and IPOs as well. Shonali Basak, our Wall Street star, thanks very much for that. For Amber Canwar, I'm Matt Miller. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, you know, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. We have about 2 hours to go. Take a look at stocks right now. That bounce that we saw fading a bit. The S&P 500 off by 0.3%. Again, that bounce fading in big tech as well. The NASDAQ 100 off by about 0.2%. So pretty small moves overall, but still definitely a down day right now in markets. Meanwhile, you're starting to see a little bit of a bid come back into the bond market after that brutal sell-off that we've seen at the long end of the curve. 10-year Treasury yields currently down by about 2 basis points. Again, small moves here, but you can see 10-year yields still hanging out above 4.30. Then you take a look at the banks. I'm highlighting the regional banks here. This KRE regional bank ETF off by 2.7%. Of course, after S&P joined Moody's, Scarlett, in cutting ratings on another host of banks.
Yeah, but when you take a step back, what we've been seeing is buying the dip, and with a vengeance, no less, because it turns out that there was plenty of net buying of U.S. stocks right as the S&P 500 was extending its slide to a 10-week low. Bank of America says its clients last week plowed $4.4 billion into U.S. equities. That is the largest allocation in 2 months. Institutional investors and hedge funds led the purchases, and healthcare names led the weekly buying. Meantime, higher for longer rates are getting in the way of an active housing market. Existing home sales fell more than 2% in July to the lowest level this year. There's a lack of inventory because people don't want to list their homes and give up the rock bottom mortgage rates that they secured during the pandemic, especially when a 30-year fixed rate mortgage is now well above 7%. All of this may work to the benefit of home builders. Toll Brothers will be reporting results after the closing bell. And I know we're at the tail end of earnings season, Katie, but there is a big one coming up tomorrow that investors are counting on to either justify or invalidate the big gains sparked by the AI hype.
Of course, we are talking about NVIDIA. Really sort of started that whole Magnificent Seven moniker that we've been talking about all year. And this is an interesting chart. You have in blue, of course, the NASDAQ 100 market cap. How much has been added to it just this year alone? We're talking $3.9 trillion almost in market cap added to the NASDAQ 100, the big tech benchmark. And then you have the Magnificent Seven in white here, adding nearly $800 billion of market cap. We're just talking talking about 7 names, NVIDIA chief among them. So it's been a pretty spectacular run in tech, even though we have seemed to hit a little bit of a wall in the month of August. So that's the stock market. Let's talk a little bit about the bond market too, because you talk about hitting a wall. You've seen rates really climb a wall over the past month or so. You take a look, pulling back 40 years, it looks like we've actually started to break out of that range. Whether or not that is enduring remains to be seen. And when we boil it down to just this week, we know that Jackson Hole kicks off in the next couple days. Of course, Jerome Powell speaking on Friday, Scarlett. We have NVIDIA earnings on Wednesday. You weigh the two together, an interesting question becomes, which matters more for investors this week?
It's a great question. It's one that we'll pose to Kathy Entwistle. She's Morgan Stanley Managing Director. Kathy, looking at this week, and I know this is kind of short term, but we want to touch on some of the big catalysts for the week. What's more important, NVIDIA and what it says about AI and spending on AI, or Powell's speech?
I think Powell's speech is pretty important. Looking at short-term companies, stocks, and how they're performing is really not the way we want to look at it overall. We want to have that long-term view when we're thinking of investing in the market. So, for example, long-term, the techs, the AI, they're going to be something very interesting in where we want to have our money. We have to not necessarily look at the short-term and look at the long-term there.
No, that's fair, absolutely. But when it comes to NVIDIA, for instance, it is at the front edge of what companies are spending and how they're spending and how they're deploying their resources to really embrace the AI revolution. So what it says will give us a sense of whether things have gone too far or whether it's all justified. What's your view on how it might shake out?
Yeah, absolutely. I think when companies are spending a lot of money in that one area and people are just feeding frenzy on it, you have to start taking a look back and looking at the numbers and thinking if it's realistic or not. So a lot of companies have come up quite a bit, and if you've been there for the ride, it might make sense to pull back a little bit and look to put your money elsewhere.
Well, let's talk about where you might put that money and whether it goes into the bond market. There was a really fiery column today from Bill Dudley saying goodbye to the bull market for U.S. Treasury bonds. And we have seen quite a brutal sell-off, again, specifically at the long end. Is it time to say goodbye to that bull market, or do you think that we're still in a secular bull market when it comes to U.S. Treasury debt?
Yeah, I think that everyone has to really look back. We've had 40 years of a bull market in the bond market, and I think that game is over. I don't think we're going to see the opportunity to have increases in the value of your bond along with the interest payment that you're getting. But we do think people are hoarding on to cash in the short term too much. If you've got money that should be invested that isn't for short-term needs, it's time to start legging that out and pushing out your duration.
How do those conversations go, though, when you're met with, but I'm earning 5% just to clip coupons and Treasury bills?
We have to remind people that it's 5% today, but if you stick with that 5% today, next year, it's probably not going to be 5% anymore, and you have lost the opportunity to build longer-term wealth with the higher rates extended out.
Yeah, these are things to keep in mind, certainly, when you're building your portfolio. As we look ahead to Jackson Hole at the end of the week, there is this market consensus that we are eventually going to get rate cuts. Explain to me how we're going to do that without falling into a deep, dark recession first.
Sure, that's a great question. If I had the crystal ball, I think we'd all be in great shape. But what I would basically say is they are going to have to cut rates. We do believe in 2024 we're going to see 4 or 5 rate cuts. And the way they're going to have to do it, I believe, is see some of these numbers. Some of the numbers they're looking at are lagging, and they have to wait till they catch up to what we're trying to accomplish in the economy. And once they see that, they can start cutting rates slowly but surely, nothing, pull the Band-Aid off, so that we can temper it and see where the economy and the market lands.
So they have to see the data that back up the slowdown in the economy. That deterioration then will happen quickly? Is that the thinking?
I think the data that is going to back up what they need to do is going to come over it quickly because it lags. So we're waiting for numbers to catch up. And once they see that what they're looking for is actually starting to happen, then they can start cutting rates, and it should not damage the economy.
So just the beginning of that change is enough?
Yes.
And how does your portfolio change at all when we finally do get those rate cuts, when that process actually starts, or will markets be well ahead of that actual process kicking off?
Yeah, I think I've always looked at markets like this. There's a lot of perception built into markets, so you have to consider that when you're building out your portfolio and when you're thinking about where the opportunities are. And a lot of people say that opportunities come during dislocation. So if you see dislocations in the market, that's really the time that you want to start taking action, not wait until it's over and people are starting to talk about it. You want to take those steps a little bit earlier.
And again, we think about the past month that we've had, both in the equity markets and the bond markets, and like we've been saying for weeks now, it is August, but when you think about where dislocations could arise across assets, where's the biggest potential?
I think it's probably still in the equity market. I know a lot of people have been calling for a long time a pullback in the equity market, and we haven't seen it. So there's a lot of FOMO going on right now, and there's a lot of cash on the sidelines, and people are starting to leg into the market. But sometimes that's when, when your grandmother starts buying stock, perhaps that's the time to start removing yourself from that participation.
So looking towards the second half of the year, I mean, we're in August, but things will get going in September. What do you think is the most underappreciated risk out there for equity investors and bond investors?
I would say two things. One is cash. There's too much cash on the sidelines. So you can't really time a market. We all know that. And the best way to look at your portfolio is go back to Financial Planning 101 and look at what do I want my allocation to look like and how can I start building towards that. So if your allocation is 50% equities and you're 60% equities, maybe it's time to start pulling back on some of those big names that have grown quite a bit. Or if it's lower than that and you need to start legging in, start doing the old dollar cost averaging in. It's boring, but it actually works, especially in this type of market.
Okay, and what about Washington dysfunction? We have the possibility of a shutdown in October once federal funding runs out at the end of September. It doesn't look like either side is interested in making any deals, so this could get ugly quickly.
I agree. I do think that is a risk that we have to keep watching and see where that goes. But that could, especially with a lot of the different things that have been happening in the markets, the banking system getting downgraded with the U.S. government in general, I think these are all things that are pointing to that risk and that we need to pay attention.
All right, Kathy, thank you so much for joining us. Kathy Entwistle is Managing Director over at Morgan Stanley. We've got a lot coming up on Bloomberg Markets at Close. As Katie just alluded to, S&P joins Moody's in downgrading 5 U.S. banks and lowering its outlook for several more. We're going to take a deep dive into why the banks are under pressure, what it means for the sector going forward.
Plus, we'll speak with the CEO of Kane Anderson Capital Advisors about why he says pace of rate hikes means we're likely in a hard landing environment.
And the state of the fitness industry post-pandemic. Joey Gonzalez, CEO of Barry's, shares with us what he sees out there. Are you working out these days?
Constantly.
You're always working out. All right, all that and more coming up. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Well, bank stocks under pressure today after S&P Global Ratings downgraded a host of U.S. banks, writing, quote, "The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen." For more, let's bring in Bloomberg Wall Street correspondent Shonali Basak. And Shonali, it's interesting, the deposit story. It feels like we're out of peak crisis mode, that maybe we're in March and April, but that deposit story is going to take a while to play out.
It is, and you were talking a little bit about the short-term rate movements earlier. It just means that deposit pressure, the cost to pay for them, could still be quite elevated. Remember, you look at some of the fintech firms, for example. They have been offering rates that you're not seeing across the banking industry at large, and to bring money into the door, you have a lot of banks still relying on things like hot money, broker deposits, to get through this phase. Now, I will say something else. You look at the sharp movements that are happening in the equity markets, and you don't see that type of pressure as drastically in the bond markets. I want to point out to Zions, for example, because Zions is one of the companies that is negative in terms of the review that S&P has put on. So, stock market does not like uncertainty, but you do see, even though it is the worst performer in the KBW Bank Index, you do see the Zions bonds really recovering here to about 77 cents on the dollar when they traded off much more steeply before. Now, as we say, the stock market does not like these new moves, and you have that double whammy of the higher rates right now, as well as this S&P downgrade, which of course makes the cost of financing all that more expensive for banks just moving forward.
Okay, so the downgrade is definitely a negative headline. Why is it then that the bond market, the corporate bond market, is kind of shrugging this off?
Well, to the point that Katie was making before, and I think this is really important, is that it's the panic mode being over. Yes, this slow bleed is painful for the bank equity, but bondholders are not seeing that same type of panic that they saw earlier this year. I talked to some of the largest credit investors who wouldn't touch a regional bank bond because they just didn't know where the future was headed. Now, with these ratings downgrades, while they are painful and expensive for these banks, you also have some silver linings. Let me take S&P, for example, where most of the banks here are placed on a stable outlook after this most recent downgrade. And then, for example, when you look at what even Moody's had said, they had said some things that, for example, if you think about the regulation these mid-sized banks are going to face, they're credit positive over the longer period of time. So again, painful right now, but there are some silver linings in what these rating firms are saying.
And Shonali, we only have about a minute left with you, but let's talk about Schwab, because shares down for an 11th day. That would be the longest losing streak since 2004. We know that they are cutting jobs. They're cutting down office spaces to save costs here. What's the current mood music around Schwab? Because again, the biggest drop since 2004.
Certainly, you're seeing these cost-cutting measures being taken. And I will say, if you look at Schwab, for example, they've been taking those efforts since acquiring TD Ameritrade. You've seen them cut jobs by the hundreds and then some. But now with these extra pressures, we've been talking about the pressure of higher interest rates. Schwab has become a bank. And so they are certainly one of the parties feeling the pain. 11-day losing streak, the longest since 2004. Really quickly, in the bond issuance that they had put out today, there's nothing very remarkable about the pricing here in terms of they had priced it 180 basis points over treasuries for the 11-year, sizable, more than $2 billion between the 3-year and the 11-year that they're offering. But it does show you, again, the divergence between what the bond investors are feeling about these big financials versus the risk that the equity markets are taking on with them.
Yeah, for bond investors, maybe we're past peak concern for the regional banks and the big banks. All right, Shonali, thank you so much. Our Wall Street correspondent, Shonali Basak, she'll be back with us later on during the show. Let's stay with bonds and banks, I should say, because despite the tough operating environment for these lenders, fintechs are fighting for survival, and they're increasingly interested in becoming banks themselves. Many, however, are finding that doing so is not that easy. Bloomberg consumer finance reporter Paige Smith has the story. Shonali was just saying that fintechs are posing as stiff competition for banks, offering juicy returns for investors, for people who want to put their money in high-yield savings accounts. Why is the operating environment for them so difficult right now?
So thank you for having me. I would say that fintechs are really sort of fighting for survival at this moment in time because, you know, we're sort of coming out of this period where we were in this lower rate cycle for quite a while, and funding for fintechs was quite cheap and quite plentiful. That is no longer the case. One study found actually that I believe that in the second quarter of this year, it was the lowest overall funding period for fintechs since 2017. So it's a tough time for fintechs, but that means that they're just having to switch up their playbook, I would say, and that means that they're looking to sort of be more bank-like and actually become banks themselves. So there are a few different paths to do that, and one path is either applying for a bank charter to become a bank, or to buy a bank, and those are both challenging paths right now for these fintechs, but they are exploring both options, I would say.
Well, Paige, let's name some names here. Who are some of the fintechs that have applied to be a bank or trying to buy a bank right now?
So Figure, which is a blockchain company that was started by Mike Cagney, who is a former SoFi founder, his firm Figure actually is the most recent example of a company to withdraw its bank charter application. And that sort of follows in the wake of companies like Brex, Opportune, BitPay, and a few others that have done the same. And that just means it doesn't necessarily mean that fintechs are not interested in being banks anymore. In fact, that is a very attractive option for them right now. It just means that the path they're seeking to take to get there is changing. So they're seeking to actually buy a bank to become a bank instead.
All right, Paige, great reporting. Really appreciate your time. That is Bloomberg's Paige Smith. Coming up on the close, Microsoft makes a new push to win UK approval of its proposed takeover of Activision. We'll take a closer look at whether or not it could make a difference. That's next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Microsoft's proposed $69 billion takeover of Activision Blizzard getting a new lease on life. That's after it submitted a substantially different deal to the UK's antitrust watchdog. Jennifer Rhee of Bloomberg Intelligence has been covering the story and joins us now. So, Jennifer, Microsoft and Activision basically conceding that they will give up streaming rights for 15 years. Do you think that this is something that was they came up with on their own, or was kind of stipulated by one of the regulators?
No, I think this is something that they came up with. It was sort of the plan B in my mind, because they reapplied for CMA, the Competition Markets Authority, re-review of this deal, and I think they tried to rely on the fact that they'd gotten a settlement in the EU and that they'd won the court case in the US against the FTC, and that wasn't good enough. But this was always on the table, because when they submitted for the reevaluation in late July, they vaguely talked about maybe a new restructuring of the deal, some other option that they had on the table. And I think because they weren't successful, I'm guessing, with getting it through on those other matters, they decided to go ahead and do this. And I really think this is going to resolve the UK's concerns.
So now we have the CMA opening up a new probe.
Right.
How long could that take? What does this timeline now look like?
So they're saying they need until October 18th, which interestingly is also the deal's end date. So I think at this point, it's probably likely they will make a decision. It'll be a good decision before October 18th, and the companies won't have to extend their deal end date yet again, because that's already an extended end date.
Yeah.
It's a phase 1, and obviously they have the right to go into a phase 2, but this truly does resolve their concerns. I mean, they didn't want Microsoft to also, they thought Microsoft had the incentive and the ability to foreclose streaming rivals. And if Microsoft completely gives up all those rights to Ubisoft, which is what it's offering to do, that concern is gone.
That concern is gone, but I mean, I'm still trying to get my head around the fact that it's giving up the future of video gaming as opposed to the past. Would it have made more sense to give up the hardware, or it just strikes me as, you know, giving up an awful lot?
It seems like a big concession, and I agree with you. I think the CMA can talk about this as a win, because it was the pressure they put on the companies to get this concession. You know, the thing is, the future is the streaming, even though it's not really happening right now. They had to do this and not something about the hardware, because this was the concern. The UK wasn't worried about consoles and that market, and it really wasn't worried about the past. What it was worried about is the future. So I think if Microsoft wanted to push this deal through, this was probably all that they could do in order to get there.
I see.
And it's interesting, you know, reading comments from Sarah Cardell, the CEO of the CME, saying that we wanted to basically test it carefully through our review, that rather than Microsoft being able to control how these cloud streaming rights are being used, that control will shift to an independent company. I mean, just again, weighing those comments, it sounds like probably this passes their test.
Right, because Ubisoft is an independent company, and so they'll take a really close look at what the agreement is, what those terms are, make sure they think it's pretty airtight, you know, that there's not some way that Microsoft can get those rights back, make sure that it's 15 years, make sure there's recourse for Ubisoft if Microsoft breaches the terms. I think once they've gone through that and they've gotten comfortable with the agreement, you're right. I think this resolves their concerns, and it's probably going to be a green light for the deal.
What are gaming companies going to take away from the action that Microsoft had to take if they're looking at any kind of combination for themselves?
I think what they have to take away from this is that if you have the hardware and you also have the cloud, that you're probably not going to be able to acquire a lot of content. I mean, I think at this point, if Microsoft tries to acquire any other content, they're probably going to hit hurdles. And for that matter, Sony also, which has the PlayStation, is one of the, basically has the biggest market share in the console world. If they try to acquire anything but a very tiny content maker, they'll probably hit hurdles too. So even though it's not what we think of as horizontal competition, you know, a content maker buying a content maker or hardware to hardware, it's vertical in nature. The type of deal that used to sort of slide through pretty easily, that nowadays going forward, that's not going to be the case.
All right, Jennifer, really appreciate your insight. That is Jennifer Rhee of Bloomberg Intelligence. And we take a look at these markets about 90 minutes to go until the closing bells. The S&P 500 currently down on the day. Scarlett off by about 0.3%.
Off by 0.3%, but everyone is keeping an eye on NVIDIA. I know it's down as well today, but it does report earnings tomorrow. At stake is the future of AI and spending on it.
About 24 hours to go. This is Bloomberg.
our economy and Greece. And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets to Close. Let's get a cross-asset check as we head towards the close of commodities markets, and Abigail Doolittle has more.
Well, overall, Scarlett, we had the Bloomberg Commodity Index down slightly, but you can see bigger moves beneath the surface, both to the upside and the downside. Starting off with the winners, I wish we had very specific stories on all these commodities, but today it's just more muted action for lack of real fundamental reasons on the day. But copper up 0.9%, taking a break from the China pressure in terms of the economy there and the idea that they are the world's largest user of natural resources. So Dr. Copper up nearly 1%, silver up 0.5%. In fact, all of the metals are higher despite the Bloomberg Dollar Index being up a smidge. This ahead of Jackson Hole, so perhaps some investors hedging that in some way. Corn down 0.7%. An early crop yield report apparently is positioning traders in a slightly bearish way. And then natural gas, the big decliner on the day, down 2.8%. This is really the weight on the Bloomberg Commodity Index. For most other commodities are actually higher. And it sounds like in terms of that Australian LNG strike, there's some progress being made in those talks, Scarlett.
All right, we will continue to keep an eye on that. It's been flying about, really volatile when it comes to those nat gas prices. All right, let's take a look at home sales, because we're getting more evidence of the headwinds facing the U.S. housing market. Existing home sales, as you can see there in the chart, sliding in July. And at blame are the highest mortgage rates in more than 2 decades, coupled with a lack of inventory. Joining us now is Bloomberg U.S. economy reporter Augusta Saraiva. Augusta, always great to speak with you. Tell us a little bit more about how much this is all due to people not wanting to give up their sub 3% mortgages.
Thank you so much for having me. And yes, absolutely. At the end of the day, this is a story about mortgage rates, and it's a story about people who locked in lower rates in the past not wanting to move. Because if you had a 2% mortgage rate maybe 10 years ago, you don't want to go for a mortgage rate that by some metrics is now at the highest level in more than 20 years, right? So that's hurting supply. In fact, we saw that in this data that we got for July, we saw that last month, the number of homes for sale was the lowest for any July on record, so that's hurting supply for sure.
Yeah, and let's talk a little bit more about supply, because it absolutely makes sense that with mortgage rates where they are, you wouldn't want to move. Maybe that's constraining supply, but what did the stock of potential homes that could be coming to market look like before we saw this dramatic surge higher in mortgage rates just in the last year and a half or so?
Yeah, so before that, the bright spot of the housing market was definitely new construction. So especially after some of the supply chain issues were solved, we saw home builders being able to work through some of the backlogs and boost new construction. So that side of the market is faring a little better. But as you said, the supply is not looking good on any of the sides when you compare it to what it used to look like in 2021 when there was this buying spree in the housing housing market, the housing market is still subdued.
Yeah. Well, existing home sales is what, the biggest part of the U.S. housing market by a long shot. To what extent do the other housing metrics, and here we're talking about smaller parts of the market like new home construction, building permits, what does that data tell us when it comes to housing? Is it a similar story? Does it confirm it, or does it present a whole new angle?
Yeah, just so that you have an idea, before the pandemic, as you said, existing home sales used to account for about 90% of all home purchases in the U.S., and that share is much lower now. And part of the reason for that is the fact that we're seeing a lot of buyers turning to new construction, especially because of, as we were talking about, the fact that there is not a lot of supply in the resale market, prices are still elevated, people don't want to give up on their lower mortgage rates, and that's hurting the market. But at the end of the day, we're getting data on new home sales tomorrow, and that's going to give us some clarity on what the other parts of the market are looking like right now.
Well, in terms of supply, it sounds like mortgage rates going lower would certainly loosen things up. So when you're thinking about mortgage rates, when are some of your sources that you speak to expecting to see some relief there?
Well, there are some economists saying that mortgage rates could go up to 8% depending on the Fed's narrative going forward, right? So right now, the expectation with the economy regaining some momentum is that the Fed will definitely keep rates elevated for longer, but there is also some expectation that more interest rate hikes could be in the horizon in the future. So that's definitely going to weigh on how high mortgage rates go in the future. There are some people expecting that once the sort of expectation that the Fed will stay high for longer subsidizes, that could translate in lower mortgage rates. But right now, I would say you have people on both sides of the spectrum with very different views for where mortgage rates are going.
All right, Augusta, got to leave it there. Our thanks to Bloomberg's Augusta Saraiva. Still ahead, we're going to recap second quarter results from Macy's and hear what the CEO had to say about consumer spending and the macro environment. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
for top calls, look at some of the big movers on the back of analyst recommendations. And we start with Evercore. It was downgraded to neutral from buy at Goldman Sachs with a price target of $140. The main concern surrounds the investment firm's near-term revenue growth trajectory, given its exposure to weak M&A trends and regulatory scrutiny in both the U.S. and Europe. Shares currently off by about 1.6%. Next up, we have Deere. The price target for Deere lifted to $430 over at Argus Research. That is up from $410. Now, the firm keeps a buy rating on the shares and calls Deere's sustainable core industrial holding in diversified portfolios, also praising the company's new management and expects, quote, continued solid earnings power in the quarters ahead. Take a look at shares right now, down about 1.3%. And finally, we have Wedbush. It started coverage of a number of e-commerce and digital marketplace stocks, including Amazon, which was rated outperform, and its price target was set to $180. The analysts hailed Amazon for its dominance in retail, digital advertising, and web services franchise. Shares currently off about 0.2%, not bad on a down day. And those are some of our top calls. Now, sticking with retails, Macy's out with second quarter results. And while comparable sales actually beat street estimates, the stock is falling and then some today after management expressed concerns about consumer uncertainty. The stock slid to its lowest level in about 2 years. And we had CEO Jeff Gannett telling Bloomberg earlier, quote, when you look at the tailwinds, they're diminished and the headwinds are increasing. Let's bring in David Swartz. He is senior equity analyst over at Morningstar, currently has a buy rating on shares of Macy's. And David, when you think about what we heard from Macy's CEOs, those headwinds increasing, and then you take a look at what we're seeing in the stock down by almost 14%, is that an overreaction?
I think it is an overreaction. The quarter itself was not that far off from what people expected. It was a quarter with declining sales, but that was anticipated. The sales actually fell a little bit less than I expected. I think the second half of the year outlook is not very good, but I don't think it was all that good 3 months ago either. So, you know, I don't think really that much has changed today. The outlook for the next 6 months may be a little bit worse, but Macy's inventories are in pretty good shape going into the holiday season, certainly better than last year.
And let's talk a little bit about what we saw specifically out of credit card revenue, because I thought this was shocking. Credit card revenue at Macy's slumping 41%. How worrisome is that to you and your bullish forecast here?
It does have an impact on Macy's bottom line because it's very profitable revenue, certainly, and it does indicate that consumer spending is declining and that credit worthiness of American consumers may be declining too. I think that is probably the main reason why Macy's stock is down today. People were really spooked by that credit card result. But, you know, credit card is only part of Macy's business. Macy's is a retailer first and foremost, and, you know, I don't think that the company really sees the credit card delinquencies as a huge problem. The company did not lower its guidance for sales for the second half of the year, really, which indicates that, you know, maybe people are overreacting to what was really, you know, one data point out of a lot of data points.
Gotcha. One thing that I noticed, David, in your report on Macy's, you described Macy's as a no-moat Macy's. Was this always the case? Can you elaborate on that? Do its peers have moats that Macy's lacks?
Generally, no. So under Morningstar's rating system, we rate all companies as either having no moat, a narrow moat, or a wide moat. Basically, that determines its competitiveness. So what we're saying is that Macy's does not have a long-term competitive advantage, and that has been the case for many years. Realistically, department stores like Macy's have been in decline for a long time, probably going all the way back to 2005 when the May and Federated merger created Macy's. Department stores have no real place anymore in American business. That's just the sad reality because really they're online retailers that have a lot of stores. Macy's has one of the largest online businesses in the United States. It gets almost no credit for it at all because people see it as a dying brick and mortar retailer. Right. So it's true that the department store model just doesn't work anymore, but that doesn't mean that Macy's has no value. Macy's does have value, but it doesn't have a competitive advantage really over anybody else. Most other department stores in the United States no longer have a competitive advantage.
Understood, understood. One thing you point out is to look ahead to Macy's strategic initiatives, including, you say, its media network. What media network are we talking about? Can you elaborate? This is fascinating to me.
Well, Macy's is using its large customer base. Macy's has over 40 million customers, and it's using its large customer base to sell products that Macy's itself doesn't actually sell. So Macy's stocks a huge number of products in its stores and online, thousands of them, but there are still thousands of more products that Macy's could sell to its customer base. And so it's really acting as a marketplace now, like Amazon, where it sells third-party products directly to consumers, essentially making money off the traffic that Macy's.com generates. And so, you know, I think this is a good move for Macy's, probably one that it should have done years ago. It's potentially very profitable because there's virtually no extra cost involved in it. It's really a very cheap way to sell products to people. It's much easier than having to take possession of inventory, which of course is very costly and requires a huge amount of cash, as well as operating stores. So that's what Macy's is trying to do. Other retailers are trying to do that too, including like Ulta Beauty, for example.
So it's asset-light, Katie, and also it explains why sometimes you can't apply your discounts to certain items purchased through Bloomingdale's.com.
Yeah, exactly. I'm learning a lot. And let's break down these results a little bit more, because going through your notes, I think it's really interesting. If you look at sort of the Macy's portfolio, you saw Bloomingdale, when it comes to sales growth, comp sales growth, Bloomingdale's saw declines, but then you look at Bluemercury, and it actually recorded a 5.8% rise. And that kind of comes to a theme that we've been talking about with some of these retailers in earnings season, that skincare, makeup, it's really sort of separated itself from the rest of the pack as we see consumers get pinched here.
Yeah, definitely true. I also cover Ulta Beauty, which has been doing very well for years. Right now, the luxury part of the retail market, as well as the wellness and beauty parts of the retail market, I think are doing much better than other areas like apparel. And so we did see that in Macy's results. Bluemercury has had positive same-store sales for the last 10 quarters in a row. It's not a very big part of Macy's overall, but it is part of the business that I think people overlook because it does have value. And then if you look at Bloomingdale's, which is probably about 1/8 of Macy's total revenue, Bloomingdale's has been performing better than Macy's for some time now, and I think that's because luxury consumers are doing better than a lot of the middle income and lower income consumers that shop at Macy's.
All right, David, really appreciate your joining us and giving us your take on Macy's. The stock, of course, tumbling today in the wake of its results. David Swartz at Morningstar Research. Coming up, we'll be joined by Joey Gonzalez. He is the CEO of Barry's to discuss the global expansion of the popular fitness studio and how work-from-home trends have impacted the fitness industry, perhaps forever. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
It's time now for our Wall Street Week Daily segment, and let's bring in David Weston with more. David.
Thank you so much, Scarlett. Well, the pandemic, as we know, made our lives harder in many ways, especially for those of us trying to get to the gym for a workout, including members of Barry's. That's the original cardio and strength interval workout. To explain where we are now, we welcome the Barry CEO. He's Joey Gonzalez. So, Joey, thanks so much for joining us. How have you come back from the pandemic? Where are you now in your business?
Thank you for having me. First of all, David, appreciate it. Happy to report that finally, as of Q1 of this year, we are 99% back to pre-COVID attendance. We do have some exceptions. We have trade areas within certain cities that are lagging in recovery as a result from work from home. A lot of those are CBD districts, areas that you would imagine might be impacted from work from home. And then also, just greater regions or cities that have been negatively impacted by migration patterns throughout the pandemic.
So tell us about the work from home versus return to office. How is that affecting you? Does it affect, for example, when people come to your facilities, what days of the week they do, or is it changing even where you're locating your facilities?
A great question. Not necessarily where we choose to locate, because luckily for us, Barry's has always looked for residentially dense neighborhoods. We have very minimal CBD districts that we entered, so there are only about 3 of them across the U.S. In terms of how it's changed sort of the way that our day works in terms of peak and off-peak, it's been really interesting. We've noticed clients are starting their days a little bit later, so our 7 a.m.-ish classes are busier than the 6 a.m.-ish, as it used to be vice versa. We've also noticed that a lot of our lunchtime classes are much busier than they used to be, so in some regards, it's actually been really advantageous. We've been able to take a lot of the demand and spread it through the day.
I know you're expanding into new locations. Is that less expensive given some of the stress on commercial real estate right now? I mean, first of all, do you franchise these operations or do you actually lease the facilities yourself?
So we're completely corporately owned and operated throughout the U.S. We do a combination of joint ventures and franchise globally. So it's a good mix of corporately owned, franchised, and joint venture. In terms of opportunities that have been presented to us from a commercial real estate standpoint, I would say that was true during the worst of the pandemic. But now that we are out of it and fitness is really on fire again, we haven't necessarily seen too many great deals.
How do you pick your spots where you want to move into? You said it's, I think you said residentially dense.
Yeah, we do. It's a little bit of art and a little bit of magic. We scrape, cities to see what types of consumers live there. We know who our demographic and psychographic clients are. We obviously look for our people, and we're very data informed. And on the other end, we really listen to our clients. We have a hyper engaged community, global community, and I can't tell you how many inbound requests we have on a daily basis to bring a Barry's to different sort of neighborhoods and cities across the U.S. and elsewhere.
I'm glad you raised the question of demographics as well as psychographics, but I'm of a certain age. I work out probably 4 times a week or so. I'm not sure even watched your videos. I'd run right into one. Do you go for basically a younger clientele?
We have that reputation. Barry's has always been an intimidating brand. The great thing is we've really evolved over the past decade. We've ensured that every class you take has something for everyone, and we give modifications, we give workouts and run speeds for beginners, intermediate, and advanced. And in addition to that, as we continue to expand speeds for beginners, intermediate, and advanced. And in addition to that, as we continue to expand the brand, we've also extended the brand into other modalities. So for example, we have a 50-minute weightlifting class. We have a new in New York City, a 50-minute ride class where you're spending half the class doing your cardio on a bike and half your class doing your strength training on the floor. So we've really sort of broadened who our audience is and continued to deliver on our vision statement, which is to transform lives worldwide.
So as you look to growth, do you look principally to increasing, I'll call it same-store growth, or is it new locations?
Oh, it's a combination. We look at both metrics. So we look at our overall attendance and revenue, and we look at same-store attendance and revenue.
How high is the sky here? Are you planning on going public, for example, with Barry's?
Everyone asks. We have, no short-term plans to go public. I've actually really enjoyed the private equity experience and relationship that I've had with North Castle Partners. They'll probably be looking to exit fairly soon, and I'm hoping we find another great private equity firm to work with.
Well, as you think about it, whether it's public or private, how do you define the market? I mean, are you looking to gain market share from other fitness organizations? Are you trying to attract people into it for the first time? How high can this go?
It really depends. I think to a certain extent, sure, all fitness concepts are fighting for market share. On a day that you do yoga, you might not be choosing to do Barry's, right? So in that sense, I understand that. But also, I think we're all sort of promoting the same thing, which is like move your body, right? Exercise, do what you can. Barry's continues, as I mentioned earlier, to extend into different modalities so that the brand can connect with people throughout the week in different ways. And in terms of, what our growth goals are, I would say that we would get to, 100 studios within the U.S. within the next 3 to 5 years. So we would double our footprint here domestically. And in terms of global growth, because it is the franchise model, the sky's the limit there.
Joey, really good to talk to you. Thank you so much. I learned a lot. That's Joey Gonzalez. He's Barry's CEO. Tomorrow, we're going to talk about some of that commercial real estate with Willie Walker of Walker & Dunlop. He's the chairman and CEO there. And then on Friday, we're going to talk with Dan Tarullo, former Federal Reserve Board governor, and that'll be about the state of the banks as we wait for what's coming out of Jackson Hole. That's coming up at 6 p.m. Eastern Time on Wall Street Week. Scarlett?
Thank you so much, David. Very timely, especially given with banks doing today, declining in the wake of the S&P downgrade, which follows Moody's downgrade. You would think, Katie, that this has already been priced in, but it's just another negative catalyst.
Yeah, it's really interesting, again, to see that really negative reaction when you look at KRE, that's Regional Bank ETF, really has not recovered at all from what we saw in March. That huge plunge, it's really just been trading around those levels for almost 6 months now.
Yeah, the big banks, on the other hand, completely different story.
Yeah.
All right, we're taking a look at treasuries right now. Of course, there had been a big sell-off. It's on pause, at least on the long end of the yield curve. The 10-year down, is that only 1 basis point?
Only 1 basis point. It's like the bond market is barely open. The 10-year Treasury yield, of course, still extremely high right now, 4.32%. Take a look at the 2-year yield above 5%. Again, this conversation that we're having about these regional banks that fight to keep deposits, 5% is hard to compete with.
And the NASDAQ clinging on to its gains right now, just up marginally, up by 0.1%.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. It is Tuesday, August 22nd, 2023. Carol Masser with Tim Stenivek. And I don't know, can we say a bit of a breather today?
Yeah, after yesterday we can.
Yeah.
Although
right?
logging in this morning, Carol, and seeing stocks surge, I was like, oh, 2 days in a row. Not actually happening.
No, exactly. We're going to get into all of that. Bank stocks, by the way, leading losses on the S&P 500. This is after S&P joined Moody's in cutting some lenders amid a tough climate. We'll talk about that, I'm guessing, in our simulcast in just a moment. Got to say that, Tim, we've got a lot of company-specific and stock-specific stories today.
Yeah, in the EV world, Nikola is down for a second day. This is after yesterday's plummet following a company warning over delivery targets. Yeah. And also, retail is huge today.
I know,
it's a big story.
Yeah, Macy's, Lowe's, Dick's Sporting Goods. Two of the names are really plummeting in today's trade. One actually to the upside, moving to the upside. So we'll break down those stories in just a moment. And then semiconductor companies, they are on our mind in a big way. NVIDIA, countdown to tomorrow's earnings as the stock hits a record intraday before backing off. So we're going to get into that one.
Yeah, we also have a story on ARM, the IPO. And, we covered that yesterday, Carol. But it turns out in that prospectus, they needed 3,500 words to explain its China risks before this IPO, which is expected later this year.
This is one of those things, right? When it takes so much to explain it, you got to be like, what?
I couldn't believe that 24% of the company's revenue came from its China operation.
Well, it's,
that is huge.
I was thinking about when that broke yesterday, and I was looking at the risks specifically, and it's like, wait a minute, this is like not such a straightforward story. So we're going to get into that. And we're also going to get into containing big technology, big tech, the big tech sector, and protecting our civil rights, economy, and democracy. It's a little bit heavy, but welcome to 2023, everybody.
You know what? When 5 companies control so much of what you do online, there's a reason why the idea of reigning in big tech is actually one of the only things that Republicans and Democrats can actually agree on.
It's pretty shocking. I mean, do you ever think about that, like all the data? Sometimes it bothers me, and sometimes I'm like, well, how else am I going to navigate this world?
I stopped thinking about it because there's nothing I can do about it.
Right. Like in order to do
anything. It's out of my
anything,
control.
Right. Anytime you agree to an app or something, it's like...
Yes.
Exactly. Exactly. All right, well, it's not all yes in the equity market. We've got the Nasdaq just a hair higher, but it's time to talk about the market. It's time to head over to our TV colleagues. That's because Countdown to the Close, it starts right now. Yeah. Well, I love that. I think, ... Let's wait until we get an ad video. No. All right, how about we pay attention to what's going on in the Panama Canal? All right, fine. All right, so over the last couple of years, we've talked about different waterways, whether it be in Europe or if we talk about the Ohio River or the Mississippi River here in the U.S. I mean, climate change is impacting riverways, around the world, and that's impacting the movement of goods. Right now, the shrinking Panama Canal water levels are bringing a slowdown to world trade. And Tim, we've got some interesting numbers about what's going on.
So it turns out that the Panama Canal, when the water levels fall, it turns out that ships wait for a longer period of time. That is a huge issue because it slows down global trade, Scarlett. And yesterday on our program, we had a great column by Claudia Somm from Bloomberg Opinion. She was joined by Mark Gongloff on our program. And they presented this really interesting conversation in the sense that when we think about natural disaster, when we think about climate change, we oftentimes think about it in the lives lost, and which is a really important way for us to measure climate change. But there's also the economic cost here, the lost productivity. And Mark Gongloff at Bloomberg Opinion argued, well, when we think about the cost of climate change, we need to think about those things rather than how much it costs to make the investments to decarbonize our future. Because that's a big part of the conversation that people focus on. They say, oh, it costs too much to invest in these alternative green sources of power. Well, guess what? It costs too much when the Panama Canal starts to sink. It costs too much in lost productivity when there are too many 100+ degree days and people can't actually work.
It's taken 4 days to get ships through the canal. Go 2 months ago and it was like less than a day. So that is going to impact things.
Traffic jam right now, if you could picture that. I feel like it's only a matter of time before companies start citing shipping difficulties, supply chain issues in their earnings reports.
I've seen this movie before. And then pressure on like prices and inflation and things go up.
Well, let's stick with earnings because, of course, it is still earnings season. And we heard from Dick's Sporting Goods, and this was really interesting. Basically, they cut their profit outlook for the full year. And the reason why they, of course, see slowing growth, they also see more theft at their stores. This is something we haven't really talked about with the retailers this season. Inventory shrink, shoplifting, employee theft, and damaged goods. It's apparently really hitting Dick's in particular, and you can see that shares currently off by about 23%. That is the worst intraday fall so far since March 18th, 2020, which was not a great time.
And Dick's, of course, not the only retailer to have cited this, right? We heard this from Target, from Home Depot as well. It's not really clear whether this is actual gangs of shoplifters operating together, or it could be theft during the supply chain in transit when things are on their way to the warehouse and they don't make it to the warehouse.
Well, you've seen the way anyone who's walked into any sort of drugstore here in New York City or anywhere in the country really and has seen like the toothpaste and deodorant behind, plastic, and you have to ask somebody to open it up, has seen the way that companies are responding to this. I think the big winner in this is e-commerce because it's so much easier to buy this stuff online when you don't have to bother with this
It
stuff.
takes 5 minutes to buy shampoo at CVS.
But it'll be stuck in the Panama Canal.
Yeah,
That's
that's
the
true,
problem.
yeah.
Better than the Suez Canal.
All I know is I have porch pirates. So when I
that's a good point.
order stuff online, it's like it started. R is right. Hey, Walmart too, by the way, has talked about that inventory shrinkage as much as like 3% or $3 billion, excuse me, annually in terms of cost. So these are some real numbers and costs for the retailer. All right, can you do that pirate thing again?
Only because you asked, Carol.
Thank you so much.
We need the eye patch too.
All right, we'll get that. All right, guys, we're going to be back in less than an hour's time. Across platform, we're talking the markets at 4 p.m. Wall Street time, radio, TV, YouTube, and of course on Bloomberg Originals. Join us then. Inventory shrinkage and Panama canals and water levels low. Not the only thing on our mind when we're speaking about trade. Let's talk about what's going on in the Treasury market because the action there is subsiding a bit. 10-year rates edging slightly lower. Benchmark yields did hit an almost 16-year high yesterday. This as the persistently resilient economy as investors continuing to position for borrowing costs that remain elevated as the Federal Reserve, Tim, tries to bring inflation closer to that 2% target. Is that the target they should be sticking to? That's another debate.
That is another debate, and it's one that a lot of us are having each and every day. Is it 2%? Is it 3%?
Exactly.
Well, in the meantime, the Fed could lose credibility if it were to consider changing its 2% inflation target before achieving that goal. That's according to Richmond Fed President Thomas Barkin. He said that at an event today, Carol, in Virginia.
He did indeed. So let's get to a roundup on the Treasury trade and yield expectations and latest Fed speak. With us ahead of the Jackson Hole Economic Policy Symposium later on this week is Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey, along with Bloomberg News Economics and Fed reporter Jonelle Marte, both on Zoom. Ira in New Jersey, Jonelle in New York. And Ira, I do want to start with you. The last couple of days, we saw a big move up again in yields yesterday, maybe coming down a hair today. Again, I love your analysis always on the trade and kind of where we go from here and what the expectations are, higher, lower, or we're not quite sure. Do we have Ira, guys?
Sure,
there we go.
Trading momentum has gotten a bit oversold when you just look at things like relative strength index. But that being said, the momentum is certainly against Treasuries right now, and not necessarily because of the Fed, right? There's other things that affect the prices other than just monetary policy and inflation expectations. In fact, most of the trade that we've seen has not come from people worried about higher inflation. It's come from the real yield side of things. So it's come from people worried about supply, worried about monetary policy over overseas. And importantly, it's really taking out a lot of, or at least some of the cuts that were priced for last year. Because remember, pricing out a cut in 2024 is as good as the Fed hiking, right? So I think they've been starting to do a pretty good job, or better job anyway, trying to dissuade the market that they're going to be cutting in significantly early next year.
So sticking with you, Ira, just for a moment. How does that then get us to Friday and what we hear from Fed Chair Jay Powell? What do you expect to hear?
Yeah, it used to be that Jackson Hole mattered because we didn't hear a lot of speeches.
Wait a second. Hold on. Jackson Hole mattered last year.
Yes, but but now we're at a place where Jackson Hole mattered last year insofar as it changed some expectations from a few weeks before because we had data that was significantly different than expectations. And yes, you can argue that the data's been a little bit better than expected, but I don't think that Chair Powell is necessarily going to change much of the rhetoric from what he said at the July press conference. And now we do get press conferences every single meeting, and so yes, might there be a little technical tweak? Might he say something like, hikes will really depend on? He's going to be data dependent, right? Like at the end of the day, that's what he's going to say. They haven't changed that for months, and there's no reason at this point to change that type of rhetoric. Whether or not they hike in September or November or not will be completely dependent on the data. But I think importantly, and this is where when you think about the title of the conference and what they're going to be talking about at the symposium out there, is the changing global economic landscape. So I think maybe it'll be interesting to hear what he says about, hey, how might some of the goings on in China and Japan and Europe affect what's going on in the U.S. in terms of the economic backdrop. That's not going to significantly change the Treasury or the rate market's opinion on where the Fed goes in the near term.
Janelle, come on in on our conversation here, because I do wonder about the unified Federal Reserve when it comes to what happens next. And especially when you have someone like also not on the Fed anymore, but former head of the New York Fed, Bill Dudley, writing specifically that the goodbye to the bull market for U.S. Treasury bonds. I mean, he's putting that out there. So it's just making us think about maybe what's kind of normal going forward. Come on in and weigh on the conversation.
So one thing that we might want to see, or that we could see from Powell, is instead of focusing more on the near term, as Ira was saying, or what they're going to do in September, it's probably unlikely that we'll get a big steer in terms of what they're going to do right now. But he might stick to his message, might make it reiterate that they're resolute, that they're dedicated to bringing inflation all the way down. And remember that even though the picture looks a lot better for them right now, inflation has been falling. I mean, recession odds are down. This is a better picture for them from when you compare it to last year. However, I don't expect him to be celebrating, declaring victory, probably going to be reiterating that they're continuing to fight this inflation fight, and maybe look longer term at the neutral rate or some of the forces out there that they are watching to shape their outlook.
I'm asking this question for Carol, Janelle, because she asked it yesterday. I gave her a hard time. When you say getting inflation all the way down, we're talking 2%. We're not talking a change target of 3%, are we?
We're talking 2%. They are very unlikely to at least say that they're changing their inflation target. It's not going to look good, as Barkin said, or Barkin says that he doesn't think it would look good for them to change it at this time. So, yeah, I mean, we're not there yet, but we have come a lot closer compared to last year.
We all in relationships learn it's okay to say, honey, I was wrong. It's okay, Fed Chair Jay Powell.
Who's the honey in this situation?
I don't know. The rest of the world. Ira, come back in, because your research that you put out, which I wanted to go to, because I know in some of the conversations when we talk about the move up in yields, you'll say, hey, it started, earlier this morning because of, with Europe and the trade there, or some news there. You write about the global tone and how the 10-year U.S. Treasury has been heavily influenced by moves during Japanese and European market hours. Why, and why this is so important to watch?
Yeah, so I think that investors are more and more global these days when it comes to investing, and certainly with setting the tone. It used to be a lot of times that U.S. Treasuries didn't move a whole lot, unless there was some news overnight. But today, however, I think the markets are so integrated that when you get news out of Japan that the Bank of Japan is going to be easing up their yield curve control, that we actually got those. There were reports that was going to happen at 3 o'clock in the afternoon New York time, and when that happened, Treasury sold off 10 basis points. People were calling me like, I don't see anything on the screen. I don't see anything on the screen. What's doing this? It's like, okay, well, do NIBOJ on the terminal, and you'll find out why the Treasuries are selling off at this point, right? And so what happens is we get these news overnight, and we get big moves, particularly in European hours, where you wind up getting sell-offs of 10, 15, 20 basis points in the UK or Germany. And as that occurs, you see these big moves in the US. Interestingly, about half the time, or a little bit more than half the time, you actually see a retracement. So basically you see bearishness in Europe spilling over into Treasuries, and then once the US hours hit, you wind up seeing some, maybe people buying at somewhat lower prices, or you see maybe European traders unwinding some of their short positions, for example. And you've seen this pretty consistently over the past couple of months. Basically, since in June and July in particular, you saw a lot of movement during Japanese and European hours, not as much volatility in U.S. hours.
Which is just a reminder, right? We are global markets. So Janelle, come on in on this ahead of Jackson Hole, where there's going to be global central bankers. You do wonder about some of the conversations they might be having behind closed doors or in walks from meetings to meetings about kind of the global sovereign trade that we have been seeing, whether it's between Christine Lagarde and Jay Powell or others.
Exactly what you were saying. This is a global economy, and even though it is, of course, Fed-centric, Jackson Hole is a gathering of global central bankers, and things are looking pretty good or better in the U.S., but you have to remember China slowed down. That's a big risk that could affect the U.S., could affect the rest of the world. There's also the concern about, slower growth in Europe and, higher energy prices and how that could affect growth over there and ripple across to markets and economies here. So, we'll probably hear a bit of cautious optimism from people out there in their discussions. Again, things are looking better, but there's still a lot to be worried about.
All right, what do you guys care more about, the Fed meeting or NVIDIA? I just want to know. Ira, do you have a preference?
Well, for me, it's always the Fed meeting. I can say that there are some people in our multi-strategy connection chat on the terminal that I help moderate that definitely care about NVIDIA. Some people are saying like NVIDIA is the new Tesla kind of thing, which is pretty interesting.
All right, unfortunately we're out of time. Listen, guys, thank you so much. Of course, Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey, joining us on Zoom in New Jersey, and Bloomberg News economics and Fed reporter Janelle Marte. She's on Zoom in New York. I think that was interesting what Ira said.
I think so too.
It's like, what do you care about? We're all focusing on AI. NVIDIA's run up. Is this one of the tech growth engines going forward?
It is, and look at the way that AI has just permeated every company report that we've seen over the last few months.
In fact, we're going to talk about it a little bit later on NVIDIA. Don't go anywhere. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here on Bloomberg Radio, and we check those markets throughout the day. We got 39 minutes to go until that closing bell clangs on Wall Street. We are looking at a decidedly mixed market right now. The Dow, the S&P, they are both lower. NASDAQ, though, on the plus side, up by 30 points right now, a gain of 0.2%. Bottom line here, stocks are struggling to find solid footing after a technical rally in big tech. Traders bracing for NVIDIA's results tomorrow after the close of trading. That report will test Wall Street's fervor around the AI hype. Right now, the S&P lower by 5, down by about 0.1%. We've got the Dow down 124, down 0.4. NASDAQ holding on to a 28-point gain right now, up by about 0.2%. 10-year yield 4.32% with a 2-year closing in on 5.04%. Again, we've got the 2-year right now 5.03%. Spot gold up $2.50 the ounce to $18.97. That is a gain of 0.1%. And West Texas Intermediate crude down 0.5%, $80.35 a barrel. Well, as for the overall market backdrop, Monica DeCenzo is head of global investment opportunities at J.P. Morgan Chase Bank.
It is shocking how sentiment has changed this year. Now, while sentiment has changed, we haven't seen the money follow it. The money is still sitting in cash. Everyone's still waiting because they feel frustrated by not seeing a more significant pullback. But it does seem very clear to me when you look at this market, soft landing is consensus now. And so if you don't share that view, then you have to be positioned for something other than that.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Cannot ignore a number of retailers today. We'll have more coming up in just a moment. But Dick's Sporting Goods plunging now by 23.9% after earnings. Macy's after earnings down 13.7%. Lowe's after earnings up by 3.9%. Again, recapping stocks mixed. S&P down 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Charlie covering the markets, covering all the movers, including the retail sector, which continues to come out with earnings. Macy's, Lowe's, and Dick's Sporting Goods all reporting shares of Macy's getting slammed. Comp sales beat, but a significant drop from a year ago shows that department store customers are pulling back on purchases. CEO of Macy's pointing to ongoing macroeconomic uncertainty and talking about promotions, quote, surgically implemented.
Sounds like precision.
This cannot be good to clear out seasonal items. Dick's plummeting. Lowe's, though, rallying after second quarter comp sales and quarterly profit beat average analyst estimates. A lot going on, Tim.
Yeah, with us, we've got a great group. Bloomberg Intelligence senior retail analyst Mary Ross Gilbert joins us on Zoom in LA. And Bloomberg News reporter Simone Foxman here in our Bloomberg Interactive Brokers studio. Simone, I want to start with Dick's and talk a little bit about this issue that we heard from Target last week. Not just about the consumer pulling back, but about shrinkage, the industry term that's used for theft, employees stealing, or damaged goods. What's going on?
I mean, it seems like a very large contributor to their earnings this quarter. And we had this with Target last quarter. Back in May, Target said it was cutting its overall estimate for profits by $500 million because of shrink. And what Dick's was saying here on the earnings call today was simply that they had not planned for this level of shrinkage. They normally get a bit more shrink and account for it around the back-to-school season. But this is more, they said it's a really big problem, and that they're doing everything they can to kind of combat it. But I think this echoes some of the other concerns that we've heard from retailers. I think one thing, and maybe this is what we're seeing in some of the trading today, it was just such a large issue. And last time when we heard Target talk about the impact overall, it was just such a surprise to people. I think that it was way larger than considered, and maybe that's why we're looking at shares.
Maybe they should put some security tags and things.
No, but that's actually a perfect segue for Mary Ross Gilbert. It's what I brought up on the simulcast a little earlier, Carol. And not to step on your feet, but I mean, the fact is if you make the changes within a store to prevent theft, there's a certain point where there creates so much friction between the consumer experience, a consumer actually trying to buy something, that it's not even worth going to the store anymore. Like trying to get deodorant and shampoo and toothpaste from a CVS behind plastic. So Mary, weigh in on this. What do you think of this, Mary Ross Gilbert, with the idea that, I said the big winner with shrinkage is e-commerce because there is so much friction now with actually going into a store.
I would agree with you there, but on the digital side, Macy's was down. And actually, Macy's called out shrink. They just didn't call it shrink. They called it shortage. It kind of confused investors at first on the call, but they quickly caught on, oh yeah, they're talking about theft. And that's exactly what it is. And look, we've been hearing about it in the news. Every week, we're hearing a group of grab and go theft going on, and it tends to be along the luxury line. So Bloomingdale's, in fact, our Bloomingdale's right next to our building here, the Gucci boutique there was robbed, I think about 3 weeks ago. So there's definitely a lot of that activity going on, and Macy's called that out also on their call. It didn't affect their margins this quarter. They have sort of budgeted for the shrink issue, but it's definitely it's something that they guided to for their third quarter as one of the factors, as well as the weakness in the consumer and the fact that they saw higher debt expense, and that's associated with higher delinquencies. They were planning for it, but it's much higher than they planned for.
It feels like we're all of a sudden talking about shrinkage a lot, but I went back and just kind of did a quick Google search, and back in 2015, Bloomberg did a whole big story about shrinkage at everything from Dollar General, AutoZone, Whole Foods, Bed Bath & Beyond, and then, Walmart. So it's been an issue that's out there. It sounds like you want to jump in.
Yeah, it's hard to, I think one of the challenges we've had, and certainly the challenge the print team has had as well, is determining how large this impact actually is, because yes, people are blaming shrink for things, and certainly in California the laws have changed in a way where the law doesn't punish theft up to a certain level, and that seems to encourage some degree of shrink overall, of theft overall, but no one can kind of tell. I mean, one thing, Tim, you were talking about how creating this atmosphere where people are worried about safety in stores pushes people to online. It's interesting because at the same time, we're seeing Macy's, we're seeing Dick's really invest in trying to get people back into stores, whether it's with Dick's and House of Sport or Macy's with its smaller, more boutique-y elements.
We talk about that a little bit because Dick's has actually just crushed it since the pandemic. I mean, the stock is up 650%, even with today's decline since March of 2020. And a big part of that is because of the huge investments that the company has made in this experiential element. So what can people do in Dick's stores that, they can't do online?
I think they're like rock climbing walls, you get special customer service, essentially engaging with the customer in a way that is not possible online, right? There's already an incentive to try and go to stores if you need a specific size. You don't know what shoe size you are, you really have to go to figure it out. Instead, you're going to order multiple shoes, and then you got the pain of sending them back and stuff. It's trying to create an incentive for people to be in stores. And one of the things we've seen across retailers is this investment into these smaller scale stores as well, to try and get people in.
So I want to go back to those that reported. So let's go back to Macy's for a moment, Mary, because what I thought was interesting is what the CEO said, and I know our team also talked with the CEO earlier on Bloomberg Television, or at least for Bloomberg Television, but these surgically implemented, talking about promotions surgically implemented to clear out seasonal items. That says to me some over inventory. So was that just bad purchasing and bad decisions? How is Macy's doing generally?
Yeah, so I think just to clarify the point on surgical, that's actually a good thing. So what he was trying to say is because they've invested in data technology and analytics, they are able to target their promotions more pointedly. And as a result, they're able to move out merchandise more quickly and not take as much of a hit as they would normally have done without that capability. So if anything, that's actually a good thing. And they were able to, clear out that merchandise well in advance of, what they were planning to do. So that is the good news. Yeah, going into the first quarter, they were seeing strength. I think everyone was. We had a good January, and then all of a sudden the world changed, and we started to see the declines, since then, and they've continued. And I think, as Gannett pointed out, I mean, the consumer is also also spending on experiences and travel. And then with their 50% of their customers earning 75,000 and under, they're strapped when you think about living expenses being so high. And look, off-price is picking up some share possibly as we've seen, strength in their figures.
I did think it was interesting that the Macy's CFO saying credit card delinquencies accelerated in the second quarter, particularly in June and July, which negatively impacted results. We've just got about 25 seconds left for Lowe's. What do we need to know?
Housing a little bit stronger than everyone anticipated, and contractor division especially kind of strong.
Is that because people don't want to move and they want to
This has been the question, right? It's a little unclear at this point. Contractor was stronger for Home Depot as well.
Which is more important to the Home Depot's business, isn't it?
Exactly.
Yeah.
Home Depot's split is 55-45, whereas Lowe's is 75 DIY to 25. Typically. But this is interesting, right? Maybe people are stuck. Maybe they're spending more. It's hard to get a sense whether this is a long-term trend yet because the dynamics are moving so quickly, but there is an undersupply of homes.
I will say Lowe's is up 3.6%, so definitely an outperformer.
The one good one. Yeah, I know.
Exactly. There's not a lot. Simone Foxman here in our Interactive Broker Studio, reporter at Bloomberg News. Thank you. Mary Ross Gilbert, our thanks to you as well, senior retail analyst at Bloomberg Intelligence on Zoom from Los Angeles.
Well, let's go from Los Angeles and New York to Washington, D.C. for a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington. Hey, Nance.
Thanks, Tim. Former Trump attorney John Eastman is one of the first of 19 defendants to turn himself in to Fulton County authorities. Eastman faces 9 counts in the state's 2020 election indictment, including racketeering, conspiracy to commit forgery, and filing false documents. After surrendering at the Fulton County Jail, he spoke briefly with reporters.
My legal team and I will vigorously contest every count of the indictment in which I have been named, and also every count in which others are named.
Eastman was a close advisor to then-President Trump following the election and allegedly pushed to put him in a slate of alternative electors falsely certifying that Trump had won. The former president plans to turn himself into Georgia authorities on Thursday. Sam Bankman-Fried returned to court today in his first appearance since a judge revoked his bail. Bankman-Fried again pleaded not guilty, but this time to a narrower list of charges related to the implosion of his cryptocurrency exchange, FTX. Bloomberg News legal reporter Chris Dolmetsch was in the courthouse.
He looked energetic. I think he's probably glad to get out of the jail for the first time in almost 2 weeks. His mother was 2 rows behind him in the audience watching, and he was energetically chatting with his attorney, so he had a lot to say.
Bloomberg's Chris Dolmetsch. Bankman-Fried's attorneys requested better access to their client and better food. He's vegan and has been living off bread and water. Hawaii officials fear there could be a jump in the death toll in the Lahaina wildfire in the coming days. The death toll grew by 1 yesterday, now stands at 115. All of the destroyed single-story homes have been searched for remains, so the effort is now shifting to multi-story structures. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We've got the Dow, the S&P, NASDAQ 100 index, all declining. In fact, we are at just about the lows of the day right now. 20 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are trading lower as the NASDAQ just went red. Dow's currently down 196 points. S&P dropped 16, and NASDAQ is lower by 8. The U.S. 10-year yield at 4.33%. Gold is up 2, oil trading in the red, and Bitcoin is down by 0.8%. Among the main 11 S&P sectors, leaders were real estate and utilities, while financials and energy were under pressure. And leaders to the upside in the Dow, Boeing and Apple, while J.P. Morgan and Merck led to the downside. After earnings, Macy's plunged 14%, Dick's dropped 24%, and in the tech space, NVIDIA had a reversal, hit an all-time high before turning negative. In other news, Schwab fell for an 11th day, the longest losing streak since 2004, and wrapping things up, Toll Brothers reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg terminal, type SQUAK, S-Q-U-A, on the terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. Charlie just breaking down the market trade for you, and you've got stocks just about at their worst levels of the session.
I've seen a little bit of little bit of selling into the close. Little bit of selling.
Yeah, I think we're just kind of waiting for clarity.
Friday? Will it be a hawk or a dove?
It's only Tuesday, Tim.
That's true.
So let's get to it, guys. Let's talk about the market trade. Lauren Sanfilippo is Director and Senior Investment Strategy Analyst for the Chief Investment Office at Bank of America, with us on phone in New York City. Big title. Tell me, what is it that kind of from day to day is always on your mind?
Well, I mean, particularly for summertime, this has been interesting recently. After a really strong 7 months, right, we've been watching stocks certainly rip to the upside here. It's a little bit of a digestion here in August, so that's making for an interesting August. And rates have certainly been
August is supposed to be, or has of late, right, the second worst month for stocks, September being the worst. So we have seen this trade before where we kind of take a breather in August.
That's right. Yep. And so I'm not looking forward to September either. To your point, worst month of the season here. So seasonality.
Lauren, do you think what's happening is fundamental or technical?
I think it's a little bit of both. I mean, so that seasonality is certainly not helping. Maybe a little bit technical too. We've seen those valuations run up, and I think this digestion is a little bit called for.
So if September is worse, how much worse? Now, how much are you looking for? Like a 10% correction on all the major equity averages? Give us an idea. If you look at some individual names, you certainly can see some interesting trends. But what is it that you're looking for specifically? And again, is it technical, fundamental? Is it just what?
I think you could see, I think under 10%, it's not abnormal for markets to be pulling back by that amount a few times a year. So the fact that we've just gone sort of straight up and to the right here on the chart sort of makes for this pullback scenario in September. So I'm weary, but at the same time, we've actually capitalized on some of these pullbacks. We think about buying into the market because, the market really hasn't afforded those opportunities year to date.
Think or do? Think about buying into the market, or do you actually buy into the market?
Well, we're advising clients, yes.
Yeah, okay.
do.
Yeah, and are they listening, or are they a little nervous too?
I mean, well, you're seeing this year sort of
this idea that there are alternatives out there, right? So we have seen some of these elevated cash positions. Money market funds certainly attractive here at 5%. So that's real yield. So there's certainly some yield chasing happening. Yeah, we're looking to just deploy these opportunities now through year end.
Are you at all concerned about what we've heard from retailers, specifically Target, Walmart, what we heard this week with executives saying that the consumer is pulling back a little bit?
I think the tone of retailers, to your point, has gotten a little bit more cautious. In first quarter, we heard some evidence of trading down, but today felt a lot different, right? I mean, we learned that more folks are sort of at different levels of income. They're shopping in big box discount stores. And then more alarming, there's even evidence of shrink or theft for those retailers. So I think that has to be telling you something.
What do you think the theft tells us, the shrink tells us?
Well, I mean, my guess, people steal out of necessity, so that's not great. We're seeing credit card balances also extremely elevated. You hear that from the Fed. So the retailers plus what the Fed has been telling us, it's sort of the same story here, right?
Although it's been happening for years.
It's just at a different scale now, I think, Carol. But I think, like you said, Carol, it's the question of, and Lauren, tell us if you have this data. I won't say it's troubling, but what I would like to know from these companies, I don't want them to lump all these losses together. Like, I want to know exactly how much they're losing just from, not from damage and not from employees stealing, but from customers stealing. Do you get any of that data?
I have not ever seen that data out there, but you'd be surprised how much, in Manhattan and here in New York City, all of the plastic that's up in front of products, you would think shrink would be down, theft would be down. So I think this is sort of, unfortunately, a sign of the times. It's really sort of a cautionary tale in my eyes.
When you look at the equity universe, I am curious, are there certain areas of the market that you think are more interesting when it comes to investment potential and return potential?
Yes, and I think sector-wise, energy complex, July and August has been good for energy. Valuations are certainly some of the cheapest in the S&P. That's not the best reason to buy, but I think a very good reason to own energy is to own them over the next cycle. And they also have some really healthy balance sheets. So I like energy here. And also healthcare, actually, as just a second sector. For its defensive qualities, I think healthcare looks interesting.
Why healthcare specifically?
I think the AI story is additive to healthcare, and I think that's a little bit overlooked. I know we've been talking about the AI story for some time now, but that productivity enhancement that AI can really offer, that seems compelling.
And where do you think the value is added there? Where do who ends up making money when it gets more productive? Because if there is an area that is ripe for disruption, it's certainly healthcare. Ask anyone who's waited, months to see a doctor and then waits hours in the office to see the doctor.
Right. It made worse by the pandemic. It wasn't so kind to healthcare, I'd say. And, telehealth had its sort of moment in the sun when we couldn't go into offices. But you're right to think that sort of healthcare, I think the infrastructure could definitely use an upgrade.
Where don't you want to be in this investment cycle right now?
Well, we've backed away from the ultra defensive areas of the market. And I think, there are some valuations in tech that don't seem so compelling here. But we do like that balance between tech, like I said, AI, that opportunity. Those are some, high quality plays we think that are certainly good for portfolios here.
I know you can't name names necessarily, but when you talk about AI and high quality, give us
single company has actually become a big time macro story. Wow. It's sort of the bellwether, right, of the AI theme. And that's been a very predominant narrative that's played out in equities this year. But I also think it's a really great check on supply chains and, the shortages that we've been talking about since the pandemic.
You're like calling it. That's what Carol's been saying, too. You're like the NVIDIA macro story.
You can say it, not me.
No, really appreciate it. Lauren, take care. Lauren Sanfilippo, Director, Senior Investment Strategy Analyst for the Chief Investment Office over at B of A, on the phone in New York City. I just, concrete. We're all so, gaga over AI. If NVIDIA continues to see demand and kind of grow into that valuation, that's a big growth story going forward.
What if it doesn't?
Wah, wah, wah. Get ready for a correction. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 7 minutes to go ahead of the closing bell. NASDAQ just turning higher. Goldman Sachs getting tough on people, employees who work from home. Goldman, one of Wall Street's most ardent return-to-office champions, is cracking down on laggards. The Wall Street giant is embarking on a fresh effort to enforce its policy of working from the office 5 days a week. Though revenue-producing employees have mostly returned full-time, senior managers have grown frustrated by the reluctance of staff in other groups constituting a significant chunk of its workforce. Right now, we've got Goldman shares lower by 0.9%. Zoom video communication shares are lower today after earnings. Zoom is down 2.3%. It did raise its annual forecast, a sign of progress on its effort to sell more products to large enterprise customers. And with more on the decline in the stock, here's Bloomberg's Ed Ludlow.
There's two diverging paths here. Sales to consumers and small businesses actually fell in the quarter 4.3%. So that growth of 10% year on year in the quarter just gone is mostly all just enterprise. Other non-video products like Zoom Phone, for example, starting to gain traction. And I think the question is here, what conditions are needed to return to growth? Because that is one that JP Morgan in particular is posing in its note this morning.
And again, we do have shares of Zoom down by 2.3%. Retailers after earnings, Macy's down 13.7%. Dick's Sporting Goods down by 24%. Those are our top company stories at this hour, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 5 minutes left in today's trading session, getting ready to head over to our TV colleagues, talk about the trade. But it does feel like, I think this makes sense as we wait for NVIDIA earnings, as we wait for more stuff from Jackson Hole. Maybe just take in a little bit of a breather here. Both the equity trade and both Treasury trade.
Yeah, I think you bring up a good point about asking what September looks like, given that seasonality does not look good in August or September. And if this is what we're seeing in August, what do we see in September? And look, past performance, no guarantee, what happens in the future.
Thank you, Mr. Mutual Fund Company.
But, the seasonality thing, it's a real thing.
No, it's absolutely a thing. And I just think we're at this funny period. We're waiting for some more economic data points. We'll get through Jackson Hole, and then we've got that September 20th Fed meeting, which will be an interesting one. Are they on hold, or do they ultimately make another move? I don't know. I just think it'll be interesting in terms of what we get for direction. So what do you want to talk about?
I want to talk about Sam Bankman-Fried.
What's up with that?
What's going on in jail right now? So
I thought it was disgusting, his jail, wasn't it?
Yeah, well, listen to this. Sam Bankman-Fried's requests for vegan meals and access to prescription medication in jail have gone unheeded, his lawyers said, adding that they need better access to their client to build his defense case. They say that, go ahead.
No, go, please.
They say the 31-year-old embattled crypto mogul has been, quote, literally subsisting on bread and water and a little peanut butter, as his attorney said, as they fought for more time with the FTX co-founder ahead of his October fraud trial. They also made their arguments as Bankman-Fried appeared in federal court in Manhattan on Tuesday to plead not guilty to a narrower indictment.
Yeah. That was his first court appearance since a judge revoked his bail after concluding that he likely tried to tamper with two witnesses. That's a big no-no, folks. Bankman-Fried's charges were cut almost by half to exclude those that weren't included in an agreement by the Bahamas to extradite him to the U.S. last year. Before we go, rich dude in jail, not happy with the situation, I will say, jail conditions for so many people from all walks of life, a lot of reporting on this, are horrendous. Yeah. And so if he isn't getting fed well or something, not a good thing, right? Like, that's a big deal.
Well, it's not just the food, it's also his prescription medication.
And absolutely. Like, you're still a human being.
His lawyer said that his client hasn't been given any Adderall since he was in jail and only has a few doses left of another prescription drug. It's the antidepressant MSAM.
So there's taking care of a human being. And then there's also the legal stuff, which is, I think, a whole other thing. Yeah. All right, folks, read that whole story. You can get it at Bloomberg.com. Right now, though, back to the markets and our TV colleagues. That's because Beyond the Bell, it starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu counting it down to the closing bell. Here to help take us beyond the bell. It's a global simulcast. We're joined now by Carol Masser and Tim Stenovic. We bring together all of our audiences across television, radio, YouTube, originals, you name it, Carol. And
we're on the moon, we're on Mars, we're everywhere.
We're everywhere. You cannot escape us, and you're taking a look at the market right now. It feels like we're in a little bit of a lull.
Yeah, and a big lull if you look at the banking sector again, right? I'm sure you guys have been talking about it. S&P joining the other rating agency, was it Moody's?
Moody's, yes. Yeah.
Moody's, thank you. And so worries about and cutting some of the ratings on some of the firms within the banking sector. So you take a look at both regional banks, the KRE, it's down about 2.8%, and then you've got the KBW Bank Index down about 2.5%. So this is really what's leading some of the declines, the major declines in today's overall trade.
Katie, you mentioned a lull, and I wonder if the lull is due to NVIDIA happening tomorrow after the bell, or if it's still going to be a lull until we hear from Fed Chair Jay Powell in Jackson Hole. Scarlett, we had Lauren Sanfilippo, Director of Senior Investment Strategy at Bank of America, joining us a little earlier. And she talked about NVIDIA being like this macroeconomic event because it's a bellwether for the entire AI industry.
It's become a bellwether for the entire AI industry, given the kind of reaction that it generated, not just for its own stock, but for big tech and anything tangentially tied to AI, right? I mean, we still see it with every company, including the words AI in their press release during earnings season.
Well, just about 24 hours ago until we get those results, you take a look at how markets closed today. The S&P 500, we're going to finish lower, about 0.3% after that pop we saw yesterday. The NASDAQ composite doing a little bit better, going to close a hair higher here. Dow Jones, though, the biggest loser today, off by about 0.5%, looks like, Carol.
All right, so we dig a little bit deeper, Katie, into the S&P 500. Most names in the index, 305 to be exact, to the downside. So certainly a risk-off trade, certainly more of that feeling in the broader market. And then, Scarlett, you've got about 194 gaining ground today.
Yeah, and so it's definitely geared towards the decliners, and you see that reflected in the industry groups. These are the 24 industry groups, level 2 for the S&P 500, and on the downside, you've got banks leading the way lower, off by 2.4% as a group on that downgrade from S&P, and chip-related companies, that's NVIDIA right there, the group losing 1.6%. On the upside, tech hardware, that's Apple, telecom services, AT&T and Verizon, and Tesla giving the auto stocks a little bit of a lift.
All right, folks, let's get to some of those individual gainers, and lo and behold, Moderna, again, atop that list. It's number 2 gainer in the S&P 500, number 1 in the NASDAQ 100, up 2 consecutive days. We're talking about a gain of about 12% in those days, still down about 76% from its August 2021 high when it traded at $44 a share. It's $116.24 at the close today, up 4.6%. Catalyst yesterday was Moderna signing that deal to study a new cancer vaccine with the China-based CarsGen. This would give Moderna a second stab at cancer vaccines. So it seems like investors continue to be excited about that. Lowe's, top in the S&P 500. I guess you guys, I'm assuming, have been talking about that as well. Number 4 gainer in the S&P. It's up 3.7% today. Second quarter comp sales and quarterly profit beat the average analyst estimate. Also slightly outperforming Home Depot, its larger competitor, for the second straight quarter. So that was definitely some standout performance there. And Hasbro, take this, Barbie and Mattel, up about 7% in today's trade. B of A boosting their price target on the company to 90 from 85. Stock closing at 67 and change. So that's quite a long runway to the upside. B of A specifically talking about successive digital games, Monopoly Go and Baldur's Gate 3. Stock is up 12% year to date versus about a 20% gain for Mattel, Tim. But that again, maybe
we got to have a games night, play some of these games.
Of course we do.
All right, let's go to the decliners. Schwab, on the other side of the S&P 500, down close to 5% on the day today. Schwab down for an 11th straight day. You got to go back to 2004 to find a time period when the companies had more consecutive down days. That was back in 2004 when it was down for 16 days in a row. The company said it plans to reduce its operating costs, i.e. cut jobs, close or downsize offices. It would save, Katie, at least $500 million annually by making these changes. Also, Dick's, we've been talking about it all day, finishing the day down by 24%. The company's worst day ever. The company cut its profit outlook for the full year, dealing with slowing growth and more theft at its stores. Check out what the company's CEO had to say. The earnings for the second quarter falling short of expectations due, quote, in large part to the impact of elevated inventory shrink. That, of course, means shoplifting, employee theft, and damaged goods. What I want to know, though, is what is just people actually
I want a
stealing
breakdown,
stuff.
right?
An actual breakdown. So perhaps we'll start to hear about those in the future. And the retail story continuing. Macy's down 14% today. The company comp sales beat analyst expectations, but there was a significant drop from a year ago that shows customers are pulling back on purchases. The question is the consumer feeling squeezed in certain areas, so it is pulling back on these purchases, like we heard from Target, like we heard a little bit from Walmart last week as well. And what does it bode for the current quarter?
Yeah, big questions. And of course, let's get over to the bond market right now. It was a quiet day after the sell-off that we've seen. You can see that U.S. 2-year yields, they did rise a little bit. That sell-off did extend at the short end, but again, muted compared to the kind of moves that we've seen. You go over to the long end, it was a pretty quiet day. You had 10-year down by 1 basis point or so. You add it together, and you did see, of course, the yield curve dip deeper into inverted territory, but again, it really feels like we're in a holding pattern until we kick off Jackson Hole.
You wonder if any of the data tomorrow will make a difference here in the sell-off that we've seen in treasuries. There's going to be new home sales, but I just referred to Cameron Kreis's entry in the MLive blog where he points out there's going to be a revision on payrolls coming out tomorrow morning, which of course is backwards looking, so I don't know that it's going to change anyone's mind. But as we, really absorb this idea that the labor market is doing just fine, it's a tight labor market, consumers are spending, if there are revisions that show that things are actually worse than what we had been thinking, that will change maybe the framework in which we're thinking about monetary policy.
We've been talking about that too as well. About 500,000 jobs could go vanishing. But what's interesting, JP Morgan kind of commenting on this, and even though you'd have that downward revision, you'd still see average job growth strong at around 300,000 payrolls a month. So it's still showing strength in the labor force. But again, you're right, maybe not as strong. And does that maybe make us rethink a little bit?
Well, I think anecdotally, we can just look and see who's in the driver's seat right now. A couple of years ago, and even last year, Katie, you had companies offering people hybrid work and allowing people to completely work from home. And just over the last year, we've seen that completely shift. And we know that what that means is the power balance has shifted, right?
And that's what I'm really interested in. Of course, if we start to see the labor market become less tight, I don't want to say it's cool off because it feels like we haven't seen that at all, but some of this bargaining power on the part of office workers, does it go away?
Well, Goldman Sachs is now tracking everyone more carefully as it tells everyone to come back into the office. Zoom, of all companies, is having people go back into the office.
The New York Times is doing it as well now for their employees, their reporters.
Yeah, they're coming back. Just want to mention Urban Outfitters crossing the Bloomberg. The retailers continue to report second quarter EPS $1.10 a share. That seems to be a big beat. The forecast by analysts was for about 89 cents a share. And this is a company that has really been outperforming this year, up 45% year to date. And just taking a quick check in terms of the stock in the after hours and just pulling it up on the Bloomberg, it's up about 2.3%. So a quick pop after beating that second quarter beat, if you will.
Okay, Richard Hayne, the company's CEO, saying, quote, "We are proud to report second quarter sales that helped drive a 72% increase in EPS. Also gratifying is that Q2 sales strength has continued to date in Q3. So seeing the same strength in Q3 that they saw in Q2. So not seeing, at least in the early parts of this report, the concerns that some of the other retailers have expressed."
Yeah, and of course, it's interesting to keep that retailer story going. It feels like we don't have a really cohesive message from the retailers so far this season. Maybe you guys have a different read, but it seems like it's been very idiosyncratic about who's doing well and who isn't.
The high end seems to be holding up just fine, and then everyone else is trading down. And if you give people a reason to buy something or go into the store or spend, and it's innovative and creative enough and a little bit out there, then it gets people's attention. But yeah, I think it's clear that there's much more discretion now in how we spend.
Hear, hear. Except for that $19 deodorant that Ken buys. That's not discretionary. That's a consumer staple.
Calling me out on
That's a necessity.
Hey, what happens during, when the mics are off stays. When,
that's the show I want to do. What happens when the mics are off. Guys, thanks. All right, that's a wrap. Our cross-platform coverage, wrapping up the markets on this Tuesday. Radio, TV, YouTube, and of course, Bloomberg Originals. We call it Beyond the Bell. Join us again tomorrow. All right. I gotta say, one of my
you like Tom Petty?
I do like Tom Petty. Who doesn't, right? Yeah. One of my favorite moments of our broadcast was Ira Jersey, our interest rate strategist here at Bloomberg Intelligence, talking about, was it on the live blog, right? And he, I said, what's more important to you, NVIDIA or Jackson Hole? And I'm assuming he's going to be like all over Jackson Hole. And he talked about on the blog saying how people, though, were talking about the importance of NVIDIA this week.
Yeah, it's funny.
In
Ben
his
Emmons,
world, right?
Ben Emmons over at New Edge Wealth, who listens to us, he sends a newsletter, he watches us. He just sent me that story, how NVIDIA's Jensen Huang may be driving Fed rate hike expectations.
I just think it's interesting that, that focal point. So anyway, this is why we wanted to talk about it. I don't always love to do previews, but I felt like this was really important, and especially when you've got somebody like our own Bloomberg News U.S. semiconductor and networking reporter Ian King, who knows this space so well. And Ian is, of course, joining us on Zoom from San Francisco. Ian, we did see NVIDIA, which has been on a tear certainly this year. I just want to pull it up to see how it closed today. It was down about 2.8%, but it did hit another intraday record today on expectations that things are going to be pretty good when it reports after the close tomorrow. Remind us why this is such an important focal point.
Well, if you believe in AI, if you believe that this is the future of computing and that it's going to revolutionize so much of the economy, then obviously, well, who's going to profit from that first of all? And, the company, arguably the only company that's really shown a demonstrable impact from it already is NVIDIA, because the chips that they provide are absolutely central to the training of all of that software that's going to do all of these magical things, so we're told.
Do you believe the hype?
I believe the numbers.
Okay.
The company this quarter is on course to report quarterly revenue that just 2020 was annual revenue. So clearly there's been a rapid acceleration there. It was a company that was a niche. Now this data center business is absolutely huge, and the majority of its business. Whether that's sustainable or not, we'll get a window into tomorrow, obviously. But in terms of proving, hey, look, here's some real numbers, we've done something, it's absolutely there. Ask me about AI in general, and I might have a different answer.
Well, we may get there, Ian, later in the program. We did just show a chart of NVIDIA stock up more than 200% so far year to date, Ian. What is it that makes NVIDIA different? What's the company's moat, and does it have any true competitors?
They have competitors who are wildly chasing them to try and catch up. The company's moat is that they saw this coming. I mean, a few years ago, a company that was making gaming chips started talking about accelerated computing, started talking about this being a thing. And everybody was like, really? Are you sure? The CEO was talking about how many people were at universities were training on his software. Every earnings quarter, we'd like, yeah, we've got this many universities now teaching people this CUDA program. And again, Wall Street was like, well, what's going on here? Why do we care? Now, fast forward to where we are right now, everybody's using their chips, everybody's using their software, because that software allows a form of computing to happen that was previously very, very difficult, very time-consuming, and very expensive. It's still expensive, but now it's possible.
I mean, at this point, considering all the conversations and all the reporting that, you and just kind of our overall team have done about the excitement of AI in general, one would assume that their numbers have to be blockbuster, right? Or is there something in the cycle that companies will buy some chips and then there'll be a little bit of a lag and then they'll buy some more? Help me out and help me understand so that I'm hopefully somewhat smart when they report tomorrow.
No, you've nailed it. That's the perfect question to be asking ahead of tomorrow, because then if you read the analyst reports, they're all over the place. Why are they all over the place? Well, 3 months ago, Wall Street got embarrassed, right? 52% ahead of what the consensus number was, right, was the projection that NVIDIA gave. Wow, right? So what's happening this quarter is all of the analysts are struggling. Well, is it going to be that strong? Is it going to be stronger? Is the projected range going to be even stronger than that? And the answer is they don't really know, because you could actually explain how strong NVIDIA's numbers are, and this is according to Bernstein, by just looking at the spending of just 4 of these big hyperscalers, of the Microsofts, of the Googles. You factor in all of the others, it could be even bigger. The gating factor on the flip side is back to supply. Did NVIDIA order enough chips? Did NVIDIA were NVIDIA as ambitious as they could have been to capture all this? Because you remember, you get chips about 4 months after you order them, and they outsource production. So their estimates of what they could do are going to be the gating factor here.
So when I think about, like, I love our supply chain function, or supply, like, right? Who are the customers? Who are the
SPLC on the Bloomberg terminal?
SPLC.
I love it. But the supply chain management, I mean, NVIDIA's got to be on top of it, right? To make sure that they can actually meet all the demand that's out there.
Yeah, I mean, the good news on that end is that the PC market still isn't great and the smartphone market still sucks. So TSMC isn't devoting as much silicon to those customers. So that, in theory, frees up this extra capacity for NVIDIA's what it calls accelerators, which everybody's buying right now. As I said, the gating factor is how well did NVIDIA see this coming? The orders that they put in 3 months ago that they're going to get chips for now. Just how much did they order? Is it enough?
So what can NVIDIA tell us? What can the company executives on the call tell us about demand?
Yeah, I mean, there's a lot of mixed signals right now. General data center demand, it's not great because everybody's spending on AI. PC demand, which is another huge market for them, that's not great. We don't have that many strong expectations for that part of their business. What will be interesting, I think, and this is what NVIDIA has been very careful and I think very sort of perceptive in what they've done, is to try to spread the use of AI beyond these so-called hyperscalers, beyond the Microsofts, beyond the Googles, beyond the Facebooks. And they're trying to basically embed the use of this technology into the economy at large. Still early days there. People will be looking for signs of that kind of spread, of this becoming a more sort of baked-in part of the economy, and that's back to your earlier comments. I think if they can show progress there, then the excitement can continue, and it won't just be a factor of what Google is spending every quarter.
So what does that look like when we actually see AI spread throughout the economy beyond these hyperscalers?
I mean, initially for NVIDIA, it looks like companies that you wouldn't expect to be direct users of NVIDIA's technology becoming exactly that. So you have maybe pharmaceutical companies using accelerated computing for drug discovery instead of using the traditional methods to get the approval that they would go through the experimentation progress. Maybe we do it all on a computer. If they start ordering in a big way, it's spread into that side. This is an affirmation of NVIDIA. This isn't just a one-hit wonder. This isn't a one-use thing. So we need that kind of use case to emerge and to become embedded, and for that to become a significant part of the spending.
I mean, that goes into the euphoria side of it, right? Like, if this just permeates in terms of the AI, the generative AI impacting everything that we do, I mean, man, off and running.
Right. I mean, it's you've seen the stories, we've written them ourselves, and you've had these conversations. Are we at the beginnings of the internet here, where pets.com and everybody else got a wild valuation that was based upon nothing? Or are we at the beginning of something which is more profound and more, going to be much deeper embedded in economic activity? Obviously, NVIDIA is arguing that that's the case. Some people who are concerned at the valuations are saying maybe this is a fad.
Ian, I asked you earlier about, who competes with NVIDIA. You said competitors are chasing them, and the difference with NVIDIA is that NVIDIA saw it coming. But who are its closest competitors right now? I mean, is there anyone? Can you name them?
Two companies, AMD, obviously another graphics maker. They have a directly comparable product to NVIDIA that's coming in the fourth quarter of this year. We'll see just how quick the uptake is on that. They've given strong projections, so we'll see. And the other one is obviously Intel. They already are in this market. But again, software, how easy it is to use what they're going to provide, because NVIDIA has made what they provide very easy to use, very just plug and play as far as the industry is concerned.
You're incredible, as always. Ian King, Bloomberg News U.S. semiconductor and networking reporter, just knows everything about
Ian, what are you doing
space.
tomorrow?
Get some sleep, buddy. Just crossing the Bloomberg terminal, UPS workers approving a 5-year contract, according to the Teamsters Union. Just putting this out. I'm looking at the shares of UPS in the after hours, not seeing much move. It's a 5-year contract, again, approved. Stock, though, not moving as of yet.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Just getting word from the Teamsters Union that UPS workers have approved a 5-year contract. The union workers voted by an overwhelming 86.3% to ratify that new 5-year labor agreement. That word from the Teamsters Union. Turned out to be a mixed day on Wall Street today. Stocks failed to gain further traction a day after the rally in big tech. Traders bracing for NVIDIA's results tomorrow at this time, which are set to test Wall Street's fervor around the artificial intelligence hype. Shares today of NVIDIA declined by 2.8%. S&P down 12, drop there of just about 0.3%. Dow Industrials down 174, a decline of 0.5%. NASDAQ up 8, a gain there of about 0.1%. 10-year yield 4.32% with a 2-year yielding 5.04%. Worth repeating on the 2-year, 5.04%. Spot gold up $2.50 the ounce now to $18.97. That is a gain of 0.1%. West Texas Intermediate crude down 0.4%. $79.82 right now for a barrel of WTI. So again, recapping here, stocks end of the day mixed. NASDAQ higher, but the S&P down 12, drop there of 0.3%. That 2-year 5.04%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie. Carol Massar along with Tim Stanovic live in our Bloomberg Interactive Broker studio on YouTube and Bloomberg Originals. So talk about shifting into low gear.
Yeah, shares of Nikola down for a second day. This time,
it's Nikola.
Down 6% after creating yesterday.
Never gets old.
This after the company warned it may not reach its full-year delivery target as it grapples with fallout from recent battery instances. Carol, the stock is now down nearly 60%.
It's pretty rough.
Just since early August.
Unbelievable. Also said in a regulatory filing yesterday that it may incur significant expenses to fix or find a replacement for that faulty part. Remember that fire in June and a second incident this month, prompting the company to recall 209 battery electric trucks. That was earlier this month, and temporarily halt new sales. There's a lot going on.
Yeah, we also got Geely Automobile Holdings. It's one of the largest independent automakers in China. They also own Volvo, among other companies. Posted at first half earnings that beat estimates. So the company's weathered a price war that continues to hit the entire industry.
There's a lot going on always with the EV world. So for our Bloomberg Plugged In today, which we do every Tuesday, back with us is Ed Ludlow, co-host of Bloomberg Technology and Bloomberg Television, joining us from our San Francisco bureau. Hello, Mr. Ludlow. Hello. So let's talk about Nikola.
Yes.
Man, it's been rough.
It's just always a roller coaster ride with this company, isn't it? It just never ends.
All right. So how do we make sense? August has not been a good month. August hasn't been good though for a lot of stocks, or a lot of companies in general.
Yeah.
So how are you thinking about this company and the news that we got yesterday?
Well, I think about it in a pretty unique way because I think it's important to share with the audience, right? I've had a pretty unique relationship with covering this company, if you guys remember, since June of 2020. And the background is that this is a company that wanted to make battery electric semi-trucks and fuel cell semi-trucks, Dow semi-trucks, as you say in the US, that are powered by hydrogen. And long story short, its founder in October of last year was found guilty of securities fraud because he'd exaggerated the capabilities of the company to investors. And things just kept getting worse and worse and worse. And it got to the stage where last week, their latest CEO, Michael Lohscheller, left the company unexpectedly because, and this is what I'm hearing from sources, is a very genuine reason that he had a family issue and he had to return home to Germany. Fast forward to Monday, and now they're telling us the reality of their situation, which is they've had some problems with a battery pack fire of late, which we can get into in a second. The net result is that they basically aren't going to do anything that they said they were going to do previously. And for anyone that's ever heard the company name Nikola, all you need to know is that they have said many times that they'll no longer be able to do what they said previously they were going to do.
So in this case, explain the battery issue and what they were what they were going to do.
So in June, there was a fire at their facility near Phoenix in Arizona, and the fire impacted a few parked battery electric trucks at their own site. And at the time, what Nikola said is that they suspected foul play. And they kind of did this so quickly, like within hours of the fire happening, they said, we suspect foul play. Fast forward to August this month, there was a second very small incident that involved a fire. The net result was that it wasn't foul play at all. No one had sort of snuck into Nikola and set their trucks on fire. What they found was the specific component from an outside supplier had resulted in a leak in the battery pack. And as you know, a big part of battery chemistry is that there are highly volatile chemical compounds and elements within it, and that's what's caused it. And so now they've got a real problem because they've discovered a pretty fundamental design issue, and it's impacted basically everything that they've achieved so far, which for many is important to probably state it's not very much. So 209 vehicles is all they've achieved since the company went public in June. They've recalled all of them, but they've also had to move to shore up their finances now as well.
Do you think about Nikola in the same vein of like Tesla in their early days, where I feel like, would put targets out, not meet it, delays, so on and so forth? It kind of became a joke, right? Like he'd say something and it would be pushed out. And then they also had issues, right? As they were creating their new cars and so on and so forth. I don't know. Is it apples to apples? Is it just difficult getting these kind of businesses off the ground, or not fair to make the comparison?
I love coming on Plugged In and on this show with you guys because we do have a little bit more time to talk about this industry, but I'm just going to be really upfront. There is no amount of time that could be afforded to us to explain the history of this company. It's so messy, so complicated. There are so many twists and turns that it just gets ridiculous. You're like, one more thing, really. So I'd really urge your listeners to go onto Bloomberg.com, or if you're a terminal user, go on the terminal and just read the stories and the reporting since June of 2020, because it's just astonishing what's happened. I think a big part of what we discovered, to answer your question, is that they had the same ambitions as Tesla to do for commercial vehicles what Tesla has done for mass market cars. And they actually pipped Tesla to it, don't forget. They did get commercial battery electric semi-trucks on real US roads before Tesla did. But then they just hit the same problems that all of these guys do when they first enter the market: a design problem or a manufacturing problem, supply chain problem. And now the fires have unearthed a pretty catastrophic engineering problem, that they've had to recall all of their trucks they've ever built so far, and also say, for the time being, we've got to stop selling these things. So it's been really messy, but that's the most succinct answer. And it wasn't succinct.
So that's okay. So we have time, Ed. So where would you say the company is in terms of mass production of large vehicles?
Yeah, so gosh, let's just do it by the numbers, because that purely gives you a sense of scale. So their official guidance for this year was 350 battery electric trucks and some fuel cell trucks. The CEO, Michael Loscheller, who departed a couple of weeks ago for personal or family reasons, had actually told me in an interview after they gave guidance that 500 might have been realistic. You compare that with Tesla, which is building now more than 1 million vehicles a year. So they are just like in the early stages. Broadly across industry, think about some of the Korean names like Hyundai, Volvo Trucks, not Volvo cars, but Volvo Trucks. All of these guys that make heavy commercial vehicles realize that there is a market for clean energy variants. And Nikola was a really sort of first mover type name, but it's taken them years to basically achieve scale of not much scale at all. I mean, I don't know what you guys think, but when I say to you, their guidance was for 350 trucks for the whole year, and they started this process years ago. That, to me, is like nothing.
Doesn't seem like many.
So, going back to, as you said, we don't have enough time to really tell their story, but having said that, do analysts and investors still think Nikola is part of the EV story going forward longer term, and they are a viable long-term player, or
still
TBD?
Yeah, still murky. I mean, only 7 analysts cover the stock. Only one analyst, who's a chap called Jeffrey Kaufman at Vertical, has a buy on the stock. Most are neutral on it. At one stage, I believe in May, I'm just bringing up on my Bloomberg terminal, right, so for most of April and May, the stock traded below $1 per share, which meant that the NASDAQ gave it a warning. On technical basis, you cannot be listed at $1 for a sustained period of time if your stock's below $1. Then it recovered, right? June into August, we got back towards $3.50 a share, $3.50 a share, and now there's just been this big drop because of this news. First, the fire issue, the reality of it, and then the guidance warning Monday. So, you know, at one point, this is the big thing. In June of 2020, in the days that followed its SPAC listing, it had a market cap that made it more valuable than Ford. But again, don't read too much into that, because that's a big part of the story of the chaos that followed, the exaggerations that its founder had made.
Yeah, that was back in June, Ed, of 2020. The market cap of close to $29 billion. Now the market cap's at $1.22 billion, Carol. It's lost 95% of its value.
All right, guys, we got to run. We ran out of time, but maybe next time we'll get into Geely Automobiles.
Ed did mention Volvo.
Oh, he did mention Volvo.
He mentioned
That's
Volvo,
right,
so we got
did.
into it a little bit.
We did get into it. All right, Ed, thank you so much, as always. Our Ed Ludlow, co-host of Bloomberg Technology at Bloomberg TV, out there in our San Francisco bureau. Hey, do want to mention Toll Brothers, their earnings just crossing the Bloomberg. Stocks just up a hair in the after hours, kind of bouncing around here, if you will. This is the company reports fiscal year deliveries, 9,500 to 9,600. Looks like it's upping it. It had seen 8,900 to 9,500. And third quarter EPS, a big beat, 373 versus the estimate of 287. Looks like their backlog is growing as well. So, and we did see a third quarter revenue beat as well.
All right, well, let's get a latest world and national news. For that, we go to Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Attorney John Eastman, one of the 19 people indicted in Georgia for allegedly pushing to overturn election results, surrendered today in Fulton County. Eastman faces 9 counts in the indictment, including racketeering, conspiracy to commit forgery, and filing false documents. Eastman spoke with reporters while leaving the Fulton County jail.
I am confident that when the law is faithfully applied in this proceeding, all of my co-defendants and I will be fully vindicated.
Eastman says Fulton County is criminalizing their rights. Former President Trump has said he'll surrender to authorities on Thursday. But Trump's former chief of staff, Mark Meadows, wants a federal judge in Georgia to block state authorities from arresting him if he fails to voluntarily surrender by Friday. Sam Bankman-Fried was back in court this morning.
The FTX co-founder pleaded not guilty to 7 counts of fraud and money laundering tied to the collapse of his crypto exchange. The revised indictment cut the number of charges against Bankman-Fried by more than half. The rest of the counts were left out under the extradition agreement with the Bahamas. They'll be split off into a separate case. This was Bankman-Fried's first appearance in Manhattan federal court since the judge revoked his bail last week, accusing him of tampering with 2 witnesses. Bankman-Fried is appealing that. In Washington, I'm Nathan Hager, Bloomberg Radio.
It's up to a federal judge in Texas to decide whether to remove a floating buoy barrier that Texas officials installed on the Rio Grande to stop unauthorized border crossings. Judge David Ezra today has been listening to arguments from both sides. The Justice Department, in a lawsuit, argued the buoys constitute an unauthorized and illegal structure obstructing U.S. waters, while Texas officials say the federal government has failed to secure the state's southern border and it has a right to defend itself. Global news 24 hours a day.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P lower, NASDAQ higher today. NVIDIA shares slumped about 2.5% ahead of earnings tomorrow. Stocks did fail to gain further traction a day after the rally in big tech. Traders bracing for NVIDIA's results, which are set to test Wall Street's fervor around the artificial intelligence hype. So today we had the S&P 500 index a fall by 12 points, a drop there of 0.3%. The Dow Jones Industrial Average down 174 points, down 0.5%. NASDAQ higher by 8 points. That was a gain of about 0.1%. 10-year yield 4.33%, with a 2-year that's now yielding 5.04%. Spot gold up $2.50 the ounce to $18.97, up by about 0.1%. And West Texas Intermediate crude back below $80 a barrel, 79.56, down today by 0.7%. As for the overall market backdrop, Lauren Sanfilippo is Senior Investment Strategy Analyst for the Chief Investment Officer at Bank of America. And right here on Bloomberg Business Week, she told us she does see a September pullback.
I think under 10%, it's not abnormal for markets to be pulling back by that amount a few times a year. So the fact that we've just gone sort of straight up and to the right here on the chart sort of makes for this pullback scenario in September. So I'm weary, but at the same time, we've actually capitalized on some of these pullbacks.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Microsoft's $69 billion Activision Blizzard acquisition got a new chance at winning approval from UK regulators after the tech giant submitted a substantially different deal to the country's antitrust watchdog. On a down day for much of the market today, we had Microsoft shares up by 0.2%. Activision picked up 1%. Again, recapping mixed day, S&P down 12, a drop there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much, Charlie Pellet. Really do appreciate it. So about 24 hours ago, if you were listening to this program yesterday.
Of course you were listening.
When you were listening to this program, and the news crossed that ARM had filed for an IPO, you'll remember this moment that Carol and I saw this headline. ARM, largest customer, ARM China, was 24% of revenue in fiscal year 2023. My jaw dropped when I read that on air.
Yeah, it's substantial, significant.
A full quarter of the company's revenue
So you're like, well, wait.
comes from China.
I want to understand a little bit more.
You know who else wants to understand this a little bit more?
Alex Barinka. She's writing all about ARM's China Challenge because in that 330-page IPO prospectus, the company, ARM, spent more than 3,500 words explaining the risks it faces in China. It's a lot. Alex is technology reporter for Bloomberg News. She joins us on Zoom from LA. Can I just say, you look so cool. For those who are watching on YouTube and Bloomberg Originals, it's like the perfect everything, including you. So anyway, thank you for being with us. I have to say, to be quite honest, when it crossed and we were all trying to read the filing and make sense of it, it was a little tricky, and we all knew we needed some time. You spent the time to go through it, and what'd you find out?
I did, and the kind of theme we saw in all of this, the sections and these IPO prospectuses are hefty documents. You said 330 pages. It's basically the first look for investors to get a real deep dive on this business since SoftBank took it private years ago. And China kept popping up from that headline that Tom ran through, that about a quarter of this business is in China through its partner in that region, ARM China, but also that there are a lot of risks around this China region. If we take a step back a little bit, we've talked a lot about the geopolitical issues with China, particularly with the tech sector and with semiconductors in particular. The current presidential administration, Joe Biden and his team, have taken a really kind of adversarial stance on making sure that the Chinese government, their military, doesn't get really sophisticated semiconductor chips. Well, ARM designs a lot of those chips, the chips that run servers, AI technology, some of the most sophisticated stuff out there there, they have more than 260 customers. So for them, as they look at this market, which is a quarter of their business, they are now kind of dealing with these blockades, these export controls, and a lot of those risk factors were built into the risk section that they talked to at length. The other thing I would point out, aside from these kind of geopolitical tensions that are causing some of this risks around the China region, they also pointed out that China's economy is slowing. We've seen the numbers come down. We know that the economic engine over there has slowed a little bit. So on top of that, this really important market that investors are going to have a lot of questions about to get it to what some folks are saying is a lofty valuation, China seems to be the number one thing that jumped out at me.
So China, big customer, right? Or the Chinese government, or China overall. Is the Chinese government, though, is there any investments in this company? Like, is there more that we want to know about kind of the connections here?
Absolutely. So ARM China is a different business than ARM. ARM is the company that's listing on the U.S. Stock Exchange. That is the one that filed this prospectus. ARM China is basically treated as a regular customer. They do have the same ownership. SoftBank does own a significant stake, a 48% stake in ARM China. But ARM warned in its IPO prospectus that this partner in China, they operate separately. They have no control over their business dealings. I'll also say there's been some drama with this company. This company's been pretty fraught if you're a semiconductor watcher. They had a CEO, Alan Wu, who in 2020 was fired for standing up a company that potentially conflicts with the business he was running in ARM China. He refused to step down. The legal system in China ruled in favor of ARM China, but that kind of drama is still up for appeal. So there could be governance issues at this all-important partner that ARM, who's filing it to go public in the US, has said they can't do business there without ARM China. So you have this kind of complex situation that when this company goes on its roadshow, when its SoftBank backers are going on its roadshow in September, as Bloomberg has reported, I can almost guarantee you that investors in the room are going to want to unpack some of these details because this is such a hefty chunk of their business.
But it's not just a hefty chunk of business for ARM. It's also, as you point out in your story, I mean, Apple gets 19% of its revenue from China. Qualcomm, 64% of its revenue from China. So
certainly,
okay.
And those are its biggest customers too.
So, I mean, what do you think? Is that okay?
Is it apples to apples?
Is it apples to apples? Look, like as these geopolitical issues ramp up, it's not just something that they have to care about. Can we sell our highest tech designs into China? They've worked around it a little bit right now. Let's say their highest, most sophisticated, most complex designs, they're actually not selling those into that geography. They've found some kind of lower, less complex, less sophisticated, less concerning to folks in the administration designs that they're selling to that market. But certainly, if you are holding this stock after this goes public, which we think will be this year, then you're not only going to be paying attention to kind of their sales, you're going to be looking at Apple, you're going to be looking at Qualcomm, NVIDIA, Amazon, name a major company, and there's a high chance, Meta, there's a high chance that these folks are doing business in China, which will ultimately back out because ARM is one of their important suppliers.
So as you see it, bottom line, as we are all excited about the ARM IPO, how do you think about the company? And it seems like a complicated relationship and exposure and overexposure to China specifically.
It is, and that'll have to be something that's balanced not only with like the excitement of this being the biggest IPO in a market that hasn't seen a lot of deals, so investors are probably hungry, but there's also some valuation questions around this. Our colleagues did some calculations looking at some of the companies that are of similar size, and on a price to sales ratio basis, our ARM should trade 32 to 34 billion, but we have reported that the company's targeting 60 to 70 billion. So there's a lot of complexities here under the hood. The company for sure will be also selling things like its importance to the AI arms race, saying we are already building in the ability to run AI technology on the chips we're designing, and we are going to be a leader in that race too. So I'm sure there'll be some kind of bright, shiny objects that the company's trying to lay out to investors saying, look, we know we have this problem with our exposure over here in this geography, but there are other major factors happening in the tech sector, other big potential economic boons for us with AI, with smartphones, with 5G, with with these big customers we have.
Right.
So why don't you guys look over here and give us that valuation?
Why does it have to always be so complicated? All right, though, for making sense out of it all, Alex Barinka, our Bloomberg News technology reporter, joining us on Zoom from Los Angeles. I will guess she and our whole team will be writing a lot more about ARM in the lead up to that IPO.
ARM Day.
ARM Day.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. United Parcel Services union workers have ratified a new 5-year labor agreement delivering substantial wage increases, concluding a tense period of negotiating that drove the company to the brink of a strike. According to the International Brotherhood of Teamsters, about 86% of employees voted to approve the deal. IBM is selling its weather business, the Weather Channel, to private equity firm Francisco Partners, which will operate it as a standalone company. Lowe's topped Wall Street's estimates for quarterly profit and comparable sales this morning, easing fears of a meltdown in home improvement. Lowe's shares up today by 3.75%, and with more on the quarter, here's Bloomberg's Kimberly Adams.
Charlie, the retailer reported earnings per share of $4.56 during that period, which was ahead of estimates. Comparable sales, a key measure of retail performance, fell by 1.6%. But this was better than forecast and also beat the 2% drop reported by rival Home Depot last week. Lowe's said the pickup in sales to contractors has helped partially offset lower discretionary spending by do-it-yourself customers and lumber deflation. Lowe's has been launching new initiatives to compete with Home Depot by winning over contractors who are the most lucrative customers in the industry. Charlie?
And that's Kimberly Adams reporting again. Lowe's shares up 3.75%. Home Depot up 0.1%. Tough day for a couple of other high-profile retailers. Macy's plunged 14% after earnings. And those are some of the company stories we're following this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. I'm Tim Stenivek. That is Carol Massar. Let's get a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks a lot, Tim. John Eastman, the conservative attorney who allegedly pushed the plan to keep Donald Trump in power, has been booked at the Fulton County Jail in Georgia today on state charges. He's one of the first to surrender in that election fraud case. District Attorney Fani Willis has accused him and 18 others, including Donald Trump, of scheming to subvert the will of Georgia voters by keeping Joe Biden out of the White House. Former President Trump says he'll surrender to Georgia authorities on Thursday. 8 Republican presidential candidates will take the stage tomorrow night for the first Republican presidential debate, but missing will be the leading candidate, former President Trump. Eli Yoakley with Morning Consult says that should help the others.
Without Donald Trump on the stage, it is a big opportunity for all of these people who want to be the Republican nominee for president to show what a Trumpless stage could look like. Make some of those arguments to the broader Republican electorate.
Yoakley says the biggest targets will likely be Florida Governor Ron DeSantis, who is in second place behind Trump in most polls, as well as Vivek Ramaswamy, who's gaining steam with Republican voters. A new version of Meta's new platform is coming. The company plans to roll out a web-based version of its microblogging app, Threads. For more, we turn to Bloomberg Intelligence senior technology analyst Mandeep Singh.
This was probably the most wanted feature, given the 100 million signups and the fact that people felt it was an impediment to, create content in terms of not having a desktop app.
Bloomberg's Mandeep Singh. Threads racked up 100 million downloads 5 days after the platform launched in July, but since then, engagement has dropped off. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Tim and Carol.
All right, Nancy Lyons, thank you so much. Nancy Lyons with World and National News down there in our D.C. bureau. So you are listening and watching Bloomberg Business Week. Carol Massar and Tim Stenivek.
That's me.
That is you.
We talked about the Panama Canal earlier today, Carol.
I am obsessed with that story. That's like the kind of thing, first of all, having been lucky enough to do a Bloomberg event.
You were there like
Panama.
a year ago, right?
I went and visited the canal, yeah. And I have to say it was eye-opening to see these massive ships.
Is it true what they say?
Is it true what they say?
Yeah.
What?
A man, a plan, a canal, Panama.
That's a book, isn't it?
Yeah, well, I think it's the same thing backwards as it is forwards.
What do you mean? A man, a plan? Oh, that's very interesting.
So is it true what they say?
I don't know.
Oh, okay.
Anyway, you're confusing me. But it was massive, like these huge ships pulling tons of it. From afar, it's like, oh, what are those little things? They're all like, tractor trailer containers. And they're massive, and it's just part of the trade flow. So that when that slows down, we've seen it in European roadways. We've seen it in U.S. riverways, if you will.